market is underestimating the strength of the US consumer.
I think the consumer is as strong as it's been.
As long as the consumer is spending, we will continue having a strong economy.
The evidence suggests it's an economy that's pretty resilient.
It's really the U.S. that is driving the world economy right now.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now with a really busy morning ahead of us. Here's the lineup for you. ECB rate decision, 8:15 Eastern Time. At 8:30, 2 data points. Retail sales, jobless claims. 15 minutes after that, 8:45 Eastern Time, Christine Lagarde speaks. That news conference for the ECB begins. And then later on this afternoon, earnings from Netflix. That's coming up a little bit later. Already this morning, tech is helping out this market. Look at the leadership. Tech is doing better than okay. The Nasdaq 100 up by 0.7%. Thank you, Taiwan Semi. TSMC delivering a beat and a raise, calming things down in this equity market after being spooked by ASML earlier in the week.
Yeah, basically now expecting sales to go roughly increase by about 30% versus the estimate of somewhere in the mid-20s. A big question mark. Are we seeing the winners and the losers from this chip renaissance in terms of which areas of the industry these chips are getting applied to? Is that what we're seeing, or are we seeing a real division to those that are most vulnerable to China and those that are less vulnerable to China?
That stock is up by almost 8% in the pre-market. Here's the line from the CEO. Anne-Marie, the demand is real, and I believe it's just the beginning.
And he was talking about the overall chip demand, saying everything's stabilized and starting to improve. If this is just the beginning, how much more can this company go? Really quelling those concerns about the agita of the future of AI, the hardware of AI. But long term, you have to think about where this company is going. They are expanding around the globe because of the concern and the overhang of geopolitics, not just what's coming out of China, but also this idea from the administration to cap some of the chips that are going to certain countries.
For now, at least, we can take a little bit of comfort from the news this morning from Taiwan Semi. A little bit later this morning, 8:30 Eastern Time, things get interesting for this market. Jobless claims and retail sales. Jobless claims. How distorted will claims be after the 1-2 punch that we've seen across some of these states in this country following hurricane after hurricane?
And will this market respond to a downside distortion or an upside distortion, actually, the wrong side of an upside surprise, more so than they will potentially retail sales that come in strong? In other words, is this market still biased to potential weakness in the labor market that could push the Federal Reserve to cut rates more significantly?
CPI came in a little bit hotter. Jobs came in great. Retail sales likely will come in good. And then BTIG had this to say: it doesn't hurt that interest rates fell in September. All of this helping out the U.S. consumer.
And as this data drops, we'll be digesting and processing whatever the ECB decides to do. And this is what I'd have to say about the news conference with Christine Lagarde. To make this more interesting, they don't cut rates. If they don't cut rates today at the ECB, then this is must-watch TV at 8:45 Eastern Time.
Basically, how will she justify it? Does she come out and give a sense that somehow she's still worried about inflation? Is this a vote of confidence that things are actually more robust? Let's be clear. Nobody expects them not to cut rates today. So that hypothetical is definitely a hypothetical. I think that actually Jordan Rochester over at Mizuho had a really interesting idea, which is essentially these news conferences give you nothing. Because basically they have not given any forward guidance whatsoever. They have been unhelpful, and any proclamations they've made have had to be reversed shortly thereafter.
They just reiterate what we hear from the Fed: data dependency. It's useful for the Fed. The ECB also likes it. Kit Jukes just dropping a note, all priced in but nowhere to go. What does this mean for the future of the European Central Bank and this potential rate cutting cycle? What did we get today? Euro area inflation revised down. So to your point, if they didn't cut, that would actually be a little bit insane given where inflation is, and this is a single mandated ECB. But then if they actually were a dual mandated ECB, they definitely should be cutting. Look at the job cuts across Europe and potentially in the manufacturing base of Germany, the idea of plants closing. This is a European economy that's in trouble.
It would be a total shocker. And to Bramo's point, in our survey, every single economist that we've surveyed here at Bloomberg for the ECB rate decision a little bit later this morning, every single one of them expects a rate cut a little bit later. Coming up this hour, this is the lineup for you. Russ Koesterich of Blackrock ahead of fresh economic data. We'll catch up with the Connecticut governor, Ned Lamont, as Harris pledges to be different than Biden. And Dan Skelly of Morgan Stanley ahead of earnings from Netflix later this afternoon. We begin this hour with stocks inching higher as traders await retail sales and jobless claims data at 8:30 Eastern Time. Russ Koesterich of Blackrock writing they continue to run modestly long in equities, but with less beta than summer. Recently, we have been adding to consumer names on the thesis that the economy will be fine and will continue to grow at or above trend? Russ joins us now for more. Russ, welcome back to the show, sir. As always, do you expect the data at 8:30 to back up your thesis?
Good morning, Jonathan. I think so. We still have an economy that's very solid. We saw that in the non-farm payroll numbers. We've been seeing in most of the data with economic releases now coming in above expectations for the first time in a while. So this is an economy where I think you can still have some confidence that growth is decent. The Fed is cutting, maybe not quite as fast as the market thinks. And, apart from some of the geopolitical risks, still a fairly decent environment for stocks.
Last time we spoke, Russ, coming into Q4, you'd reduced your overweight on equities just a little bit. I sensed a bit of cautiousness around valuations. Where are we now?
That's fair. And the equity market is not cheap. We know that. But within the Global Allocation Fund, we still have maintained what I call a modest risk-on stance, and that takes a couple of forms. One, we're still a little bit above benchmark in terms of equities, actually a modest amount above benchmark. We're still very long spread products in the fund, high yield, investment grade, securitized. And the notion there is, in that 40% of the sort of a traditional 60-40 portfolio, for the first time in years, you can actually get a decent 6 to 7% yield, get that tailwind from carry. And then finally, we're long the U.S. We're long the U.S. on the tech side. We're long the U.S. on the consumer side. And that still reflects the fact that these are the companies that we see delivering on cash flow, margins. We still think there's upside.
That said, Russ, you said that you've been recently trimming your tech exposure. And I'm wondering why, especially in light of the different kinds of messages we're getting out from ASML as well as TSMC.
Yep. Well, to be clear, we are still long tech within the Global Allocation Fund. We're just less long than we were over the summer. And the reason there is, again, some of these trades had gotten very crowded, particularly around the semi space. Valuations, they've been stretched. But if you look at out 3 to 5 years, I still think these are names you want to own. What we've been trying to do is we've been lightening up a little bit. When we see these positions get crowded, we've been buying back on some of the dips. So it's really tactically trading around that core long position, just not quite as long as we were back in May and June.
You talk about being overweight the U.S. You talk about credit products. You talk about stocks. I don't hear a lot of 30-year treasuries. In fact, I hear quite the opposite. And I really want to talk about why, especially as you shift toward gold, which is sort of fascinating as we see it break out yet again. Can you explain those two trades and how they're related?
Absolutely. So, we've spoken about this before, Lisa. I think there are a couple of issues on long-dated treasuries. In the middle of the curve, 3 to 5 years, we still see some good opportunity. With the long end of the curve, you've got a few issues. The biggest one is supply. You're only getting a yield of about 4% on the 10-year. You've got massive amounts of supply. You've had a pullback in some of the buyers that were very active a decade ago, from the Fed to the Chinese to regional banks. And there's not really a lot of risk premium in going far out on the curve. At the same time, one thing treasuries are not doing as well as they were doing 5 years ago is they're not providing that consistent hedge. Last decade, not much of a yield, but very good from building a multi-asset portfolio because they did reliably tend to give you a negative correlation to stocks, less so today. Gold is a bit different. I'm not sure that gold is going to give you a great hedge on a day-to-day basis, but we're all talking about the deficits. We're all talking about the sustainability of U.S. debt. One of the advantages of gold, it's a scarce asset. And as we think about the long-term direction of the dollar, the long-term direction of U.S. Fiscal sustainability, in our opinion, gold is one of the assets that is diversifying in a portfolio with that longer horizon.
Russ, so basically you have two ideas at the same time. You're overweight the United States, but you're still concerned about its long-term trajectory. So do you think that at some point someone's going to call foul on U.S. exceptionalism?
I think it's a really fair question. And I think part of this comes down to time frame. It also is a question of the private sector versus the public sector. Now, in the private sector, we still see world-beating companies in technology on the consumer side, on the energy side, that we think can continue to grow. The challenge in the U.S. is not the private sector economy, it's public sector debt. And we think about an asset class like gold, it's really directed at that longer-term concern around the public sector fiscal sustainability.
And Russ, you've also got to acknowledge that exceptionalism is a relative game. What's the rest of the world actually offering right now? And what I see over in China based on LVMH is not much. What I see over in Europe, based on the ability and willingness to carry on trying to fine everybody, is not much. Russ, what is on offer in the rest of the world?
I still think there are places you can look at from a bottom-up basis. We found opportunities in Japan on the technology side. You're right. Europe has been challenging. Growth has been slow. There are companies there. But you raised a very good point. One of the challenges of investing in Europe, and this has been the issue now for a number of years, is not just the slow growth. It's also the leverage to China. And whether you're talking about luxury good manufacturers or German industrials, you have to have a view on China if you're going to be long some of these names. And when you do see disappointment in Chinese retail sales or the overall amount of stimulus, these are the names that are hit first.
Great to catch up, Russ. As always, one of the best. Russ Koesterich there of Blackrock. I make that very snarky point on the EU for a very specific reason. This story crossed just moments ago. The European Union has warned X that it may calculate fines against the social media platform by including revenue from Elon Musk's other businesses, including SpaceX and Neuralink. This is the problem with Europe, away from this story. The fact that we keep seeing headlines like that, the fact that we aren't taking a big step back on the continent and saying, where's our SpaceX and what are we going to do about it, is part of a much, much wider problem that's been plaguing this economy for a long, long time.
What's the saying? The U.S. innovates, the European region regulates, and that's sort of the message that you keep getting. How much does this really hamper the creation of new technology, and the fact that we're seeing ASML and other tech in Europe underperform at the same time that others outperform tells you quite a bit.
And also, when it comes to the European Union, it's not just what they're doing, Jonathan, in terms of X. They've done this with Apple, with Amazon, go after all of the U.S. companies. To your point, the United States, they're the ones that come up with the inventions. The U.S. go and regulate it, and the Chinese, I think,
Replicate,
that's it.
It's innovate, regulate, replicate. I'm pleased we got there eventually. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. It's early morning. It's Danny Berger. Hey, Danny.
Hey, John. President Joe Biden is heading to Germany for a visit with Chancellor Olaf Scholz. Trade, China, and the war in Ukraine are all on the agenda. It's Biden's first trip abroad since announcing that he would not seek re-election. Biden arrives this evening with a midday meeting with Scholz tomorrow. He will also be joined by UK Prime Minister Keir Starmer and French President Emmanuel Macron for the meeting of the Transatlantic Quad to discuss Russia and the conflict in the Middle East. Billionaire investor Stan Druckenmiller says that markets are pricing in another Trump presidency, but he told Bloomberg exclusively that he will not be backing the Republican contender or his Democratic rival Kamala Harris. Druckenmiller called Trump a blowhard while saying a Harris presidency would be bad for business. Apple's chief people officer is leaving the company after less than 2 years on the job. Sources told Bloomberg that Apple employees were notified of Carol Surface's departure yesterday. The chief people officer title was created for Surface, who is tasked with overseeing human resources, inclusion, diversity, and recruiting for Apple's roughly 160,000 employees. Her tenure is considered short for a senior executive at the company, reporting to CEO Tim Cook. And that's your brief, John.
Danny, thank you. How many people feel like Stan Druckenmiller? His views on the election, doesn't that resonate with a lot of people at the moment?
Looks like he's not voting. And I think that resonates with a lot of people who they're not in either camp and they just can't bring themselves to vote for either candidate.
Don't know which way to turn going into November.
Yeah, what I thought was interesting about what he said is that the market seems convinced that Trump is going to win. And that's getting increasingly priced in. And that, I think, is really fascinating, given that you have still a race that is very much tied.
It's such an important observation. You do get that sense, don't you, that the market started to lean in one direction at a time when the polls are pretty even. Things are pretty finely balanced still.
What we've seen, though, consistently is that even if people think they understand what a trade is, they never really understand it until it actually happens, and then you actually get a sense of what that trade is. Right now, you have people saying different things on both sides in terms of what's going to happen, regardless of what happens. We shall see on November 5th, 6th, 7th, 8th.
But he said
10th.
But he said he liked the financials. Is that really a Trump trade, or just the fact that the bank stocks, the bank earnings had a blowout quarter?
To Lisa's point, you can make a big call on what this all means for financial markets. We all remember overnight what happened back in November 2016. Things changed very quickly. Up next on this program, making a difference.
Let me be very clear. My presidency will not be a continuation of Joe Biden's presidency. And like every new president that comes in to office, I will bring my life experiences, my professional experiences, and fresh and new ideas.
A fiery interview between Kamala Harris and Fox News. That conversation up next from New York. This is Bloomberg. Live from New York City this morning. Good morning to you all. Welcome to the program. Equity futures doing okay. We're positive by 0.4% on the S&P 500. Later on this morning, 8:30 Eastern Time, important economic data, retail sales and jobless claims just around the corner. Under surveillance this morning, making a difference.
Let me be very clear. My presidency will not be a continuation of Joe Biden's presidency. And like every new president that comes in to office, I will bring my life experiences, my professional experiences, and fresh and new ideas. I represent a new generation of leadership. I invite ideas, whether it be from the Republicans, the business sector, and others who can contribute to the decisions that I make.
Here's the latest this morning. The vice president putting some distance between herself and President Biden with election day less than 3 weeks away. And new polling from Fox News showing Donald Trump leading Kamala Harris by 2 points. Joining us now to discuss, a good friend of this program over the years, the governor of Connecticut, Ned Lamont. Governor, it's good to see you, sir.
I see you, John.
Welcome back to the program. She's taking some risks that maybe this campaign wouldn't have taken maybe a month ago. Do you like what you see?
Yeah, take those risks. Go right into the lion's den. Go right there with Brett Baer. Go back and forth. You know, Donald Trump won't even debate again, and she's having a pretty good debate. I appreciate that.
Is it too late, though? Should she have done this interview 2 weeks, a month ago, the week
She's only
after
been
the
a candidate
DNC?
for 90 days. I think she's moving along. I mean, Donald Trump won't go on ABC without suing him, so I think she's doing okay.
So do you think she's evolving as a candidate then, over the course we've seen since July?
I think so. Everything has been so compressed for her and Tim. But now we're in the final stretch.
So this weekend, you're hosting a fundraiser for Governor Walz, her running mate. Have you been happy with his performance as her running mate, supporting Kamala Harris?
Look, I love Tim. He and I were elected at the same time. All the governors, both sides of the aisle. He's so genuine. He's so real. We like governors, by the way. You know, governors have to balance budgets and live in the real world, unlike these other guys. I think he's going to be a great vice president.
So you're praising some of his work. He used to be, when he was in Congress, a blue dog Democrat, a moderate. As a governor, he's very liberal, legalizing marijuana, licenses to undocumented immigrants in his state. Do you think that, given his record as governor, he was the right choice for a general election when the Democratic Party needed to be seen as coming into the middle, especially after VP Harris's flip-flops from her primary?
I don't know. Legalizing marijuana, does that make you liberal? I thought it was sort of libertarian. I think you see that happening in states across the country. You know, fighting for a woman's right to choose, that's about freedom. I don't think that's particularly liberal. Like I said, he balances budgets, so I think he's got a pretty good balance there. He's pragmatic.
Well, there's a question here about how much the Harris-Walz campaign is really going to reach out to business. And Tim Walz is going to Greenwich, Connecticut, where he's going to be talking with a lot of business people. How are they responding to some of their concerns, whether it's about tax increases, whether it's about, having a viable immigration policy, or frankly, when it comes to antitrust and the ability to understand whether or not Lena Khan's going to remain in the FTC?
I like the fact they're reaching out to business. I think the Biden administration was a little more ideological. I think Harris-Walz are much more pragmatic. I've seen that in crypto. I've seen that in what they want to do with capital gains, not do as much as President Biden. They take the deficit very seriously, as do I. Nobody else seems to. But I think their outreach makes sense, and I'm proud he's coming to Greenwich to tell the story.
Do you have a sense of what they're going to do with antitrust?
I don't. That's not the sort of an insight I have. My instinct is, if they talk about price increases, they worry a little bit about monopoly pricing and pricing power. So probably they'll be, strict when it comes to antitrust.
One thing that you've talked a lot about with us is this question around immigration. And you're talking about how there are people coming to Connecticut that made you really gut check some of the assumptions. Do you think that there is anything further that they can do, the Tim Walz and Kamala Harris campaign, to sort of change the narrative that their immigration policies led to a lot of problems?
I start with the fact that this is a country built on immigration, legal immigration. That's part of our economic strength, unlike other parts of the world where people keeping out. If they had asked me last night what's the difference between you and President Biden, I would have said, Mr. Biden, give me the tools I need to shut down the border to illegal immigration. I think that's what Kamala should have said, and I think that's what she believes.
Why do you think she won't say it? I think this is the problem that people have right now. I'll frame it as follows. You say she's pragmatic. You say they're both pragmatic. Other people might use a less kind phrase. They might say she's a shapeshifter. She just wants to get elected. Untrustworthy. These were the values, the thoughts, the policies of just 5 years ago, and now all of a sudden they're over here. How can we trust them? What's the message to the electorate with that in mind?
Boy, talk about a shapeshifter. Talk about no principles. We're talking about Donald Trump there. Look, I think you know where she stands on these issues. Look, she was a vice president, Jonathan. Vice president's not worth a warm bucket of spit. And so everybody's saying, boy, you were on board with the Biden administration. That's sort of your job as vice president. Now she's been a candidate for 90 days, and I think she's showing her stuff.
But if you think the vice president's job is that important, then how is she qualified for this job if she's running on some of her time in office as vice president?
I think it's a pretty good training ground, don't you? I mean, J.D. Vance stopped by the U.S. Senate for a cup of coffee. You know, she's been front and center as a senator. She's been front and center as vice president. I think she's got the training, the experience she needs to be a really good president.
So some states are already voting. I know Connecticut now, you can go out and vote on Monday. I saw that you said you're going to vote on Monday, get in there early. What does she need to do as really people are already out and about voting? It's not like she has time before November 5th. The time is now. The election has already started.
I'm just urging, look, my friends, I'm a little worried. You know, the guys in sort of finance world that I know, maybe it wasn't so bad under the Trump administration. Maybe I'll sit this one out like Druckenmiller. No way. This is a transcendental vote we've got coming up here right now. I came into office under President Trump. The government was shut down. Remember, every time you didn't get your own way, you shut down the government. You know, then we had COVID, and he said, we don't have a stockpile. You don't have any stockpile. We had to go to China to buy our masks. It was dysfunctional there for 2.5 years. This election is that important. I can't stand people saying, maybe I'll sit this one out.
Let's get into some of the issues. You've got a very low unemployment rate in the state of Connecticut, something around 3.5%. Part of that is because people have been leaving the state. We all want legal immigration. In fact, the former president himself, Donald Trump, in a conversation with us, actually talked about that he wants legal immigration. How are we going to achieve that as a country? It's something that I think a lot of us can agree on. That's what we want. I went through a very long process to be here. I know how difficult it is. How do we make it easy for people to come here legally to fill the job openings that you have in a state like Connecticut?
Well, first of all, I'll challenge your pretext. We have a lower unemployment rate than the rest of the country. It's not because people are leaving the state. In fact, for the first time in a generation, people are moving into the state, some of them coming from New York, and I'm really proud of that fact. How do you keep that economic momentum going? You know, for us, manufacturing, onshoring manufacturing, we have a lot in the defense trade. They're growing. It's a bigger piece of our economy. Fintech and life sciences, sort of the next generation. We had a lot of old industries, Jonathan, right? That was sort of our reputation. No longer.
Yeah, but you're talking about what policies going forward can there be to be implemented that actually can be viable immigration policies. I guess the bigger takeaway is you said that a lot of your business friends and colleagues are on the fence, like Druckenmiller, don't want to vote necessarily, feel like it's an equal chance between the two. What do you think is driving them to feel that way? What do you think is the most misunderstood policy that you kind of want to underscore and want them to understand?
I think for a lot of those folks, cut my taxes is kind of determinative there, despite what it means to the deficit, despite what it means to making investments. Look, you know what I like about Kamala? She's not talking about handing out money to people. She's talking about opportunity. She's saying, with daycare, I'm going to give you the opportunity to start your own business. It's an ownership economy. I think it's a different feel than we had for the last 4 years.
Governor, you're always generous with your time. It's good to see you again, sir. Let's do it again soon.
Thanks, Jonathan.
Thank you. Governor Ned Lamont there of Connecticut. Up next on the program, we'll catch up with Andrew Balls of PIMCO on his latest outlook for the economy and for the bond market too. Equity futures on the S&P 500 up by 0.4% from New York. This is Bloomberg. Equities doing okay this morning, up by 0.4% on the S&P 500. Just a bit of outperformance on the Nasdaq. The Nasdaq 100 up by 0.8%. ASML spooked this market, came out with pretty dreadful earnings. TSMC has made up for it. Taiwan Semi with a beat and a raise and a bit of comfort in the tech sector. The Nasdaq 100 up by 0.8%. Switch it up and get to the bond market. 2-year, 10-year, 30-year looks a little something like this. The 2-year at 3.95, the 10-year just north of 4%. Going into some really critical data later on this morning. Jobless claims. Jobless claims is really tricky. The highest of the year, we gapped out just last week. Lots of excuses for it. Begins with an H, ends with Kane. Hurricane, and there have been hurricanes, which means ultimately here, Bramo, we could have another spook jobless claims print a little bit later this morning.
That was subtle, by the way. It starts with an H, ends with hurricane. It's sort of good. I like that. Honestly, yes. I do wonder, though, whether we've shifted the narrative just a slight bit, because there was a bias in this market to overweighting any potential weakness that was being perceived in the labor market. Given all the commentary we've heard from the banks, given the solid data we've seen from likes of Bank of America looking at consumers, or Morgan Stanley, or JPMorgan, is there now less of a bias to look for weakness and possibly an upside surprise to initial jobless claims?
If you want to find some weakness, look to Europe. The euro right now, totally unchanged, 108.62, going into the ECB's meeting later this morning, the decision a few hours away. The last time this ECB met, they were still doing that whole meeting by meeting, we don't know, everything's a live meeting, we probably won't cut interest rates for the time being, and then the data happened to them. And all of that in the last month or so. Inflation, headline, below target, 1. PMI's absolutely terrible. And overwhelmingly, the view on the south side, take a listen to this. This comes from Deutsche Bank. The European picture has weakened considerably. Goldman Sachs, Eurozone data have been significantly weaker than expected. JPMorgan, there is a strong case for delivering cuts a bit more quickly to help avoid a more abrupt growth slowdown.
There is a great expectation right now in markets that this will be the first back-to-back rate cut for the cycle, and it will begin a basically rate cut per meeting going into the remainder of next year. I really can't emphasize enough what Jordan Rochester said. I struggle to see it being a materially informative and therefore market-moving press conference, but I'd love to be wrong. Essentially, everything that she has said has turned out not to be the case. And that ultimately is the reason why people are going to price in these rate cuts, even if she says she's still data-dependent in the news conference.
Well, the rate cut earlier in the summer, they were accused of being data independent and not data dependent. When it comes to the data, I'm interested in this, the approach. Central bank differences, the Federal Reserve and the ECB. The Federal Reserve is using this phrase, recalibration. It's a recalibration effort. The ECB is going meeting by meeting. And I just wonder whether that needs to change after the data of the last month and whether we get any hint of that in the news conference later on this morning. That would be quite a big shift. I'm not expecting it, but it would be something to look for a little bit later.
Consistently, the inflation data in Europe has come in below expectations. Consistently, the economic data has come in below expectations. The fact that they still are talking data dependency might speak to a different regime if they're actually in the face of inflation that's going to struggle to be above 2%, let alone below 2%, as well as weakness. So do they start to telegraph a more protracted path of rate cuts?
There's an extra line in that JPMorgan quote that's just as important, and I'll read it again. There's a strong case for delivering cuts a bit more quickly to help avoid a more abrupt growth slowdown and hence a disorderly disinflation process. Is that the risk for the ECB?
Put another way, are they worried about having to combat disinflation and even deflation akin to what it was pre-pandemic? Is there a shifting narrative in Europe that is very different from in the U.S., where people are still worried about sticky inflation in certain sectors, like airplane tickets that we heard about yesterday?
That sounds personal. Euro dollar, 108.62. The decision, 8:15 Eastern Time. The news conference, 30 minutes after that. Out of Surveillance this morning, Vice President Harris vowing to be different from President Biden in an interview on Fox News, pushing back on criticism over the border crisis and transgender rights. New polling from Fox News showing Donald Trump leading Kamala Harris by 2 points.
So she was forced right off the bat with Bret Baier to really defend the administration that she is currently part of, their border policies, and why they decided to get rid of the Trump-era policy of remain in Mexico. And immediately you could tell he wanted to stump her on how many immigrants have entered the United States. And she was filibustering a bit here. But depending on how you look at it, whether your politics is, either she did well or she didn't, because you already went in liking her or didn't, I imagine, for a lot of individuals. But at the end of the day, she was forced to really have a substantive policy-focused debate, and some of the best exchanges of this cycle for her was during that debate. And she probably should be doing more interviews like the one she did last night.
Yeah, I mean, like on Bloomberg, for example. Anyway,
That'd be
I just
great.
want to point out, it's very
request is
difficult.
in.
Okay, it's difficult right now because are we actually hearing anything on the policy front from any of these interviews? No, this is about trying to massage a message to the middle and really, I guess, cater to people to realize that you're reasonable, whether you're Donald Trump or whether you're Kamala Harris.
This is where I wonder if she did win over the individuals she was going after. And those are the Nikki Haley Republicans that are not sure if they could vote for the former president. They don't like the fact that a number of individuals, especially in the national security space, say he's unfit to govern, like Ambassador John Bolton has told us on this program. Did she win them over? Because at the end with Iran, Brett Baer made a great point. They put up a full screen of it, talking about the oil exports that Iran has made during this administration and the money Tehran has garnered from it.
More on that interview a little bit later this morning. Elsewhere, Chinese stocks slumping into a correction after another disappointing policy briefing. China's pledged to nearly double the loan quota for unfinished residential projects to $562 billion, falling short of expectations. We had a big lift in this market, and then people started to go the other way very, very quickly over the last week.
Is it a trade or is it investment? Pretty much everyone who came on the show said it was a trade, and we're seeing how much of a trade it actually was. The promise of stimulus is not the same thing as the follow-through of growth on the heels of that stimulus, especially if you don't have a sense of exactly where it's headed or what the headline number is going to be.
Let's turn to the latest from TSMC, hiking its revenue outlook after delivering better than expected earnings, looking for sales to climb about 30% in US dollar terms this year. That's up from previous projections for about a mid 20% rise. That stock is up by more than 8%. That's given the Nasdaq a lift this morning as well. Some outperformance on Nasdaq futures this morning. This morning, we'll be focused on US retail sales and jobless claims data due out in just under 2 hours' time. Investors looking to the data for evidence of a soft landing. The team at PIMCO out with their updated secular outlook, writing, the US economy, like others, appears poised to achieve a rare soft landing, moderating growth and inflation without recession. But there are risks, such as the upcoming US election and its implications for tariffs, trade, fiscal policy, inflation, and economic growth. Andrew Bors of PIMCO joins us now for more. So, Andrew, that's basically everything. How election dependent are we in 2025?
So it's clearly a very, very significant event for the US and for the world. I was listening to your discussion on Europe, and if you want a bearish case on Europe, then the risks around trade war, 50% chance, give or take, for a Donald Trump presidency, and the comments on tariffs, you would tend to think that China clearly would be significantly impacted, but Europe you would really see as a loser in terms of a global trade war. So I think that's just another issue there on the European side. So very consequential, I think, particularly around trade. On the fiscal side, probably. If it's going to be divided Congress, not quite such a significant factor. You're going to have ongoing, very high deficits, regardless of the outcome of the election. But the trade part of this, the risks around the global trade war, domestic impact in the US, and the international impact does affect, everything, as you said.
Andrew, do you think that just reinforces your belief, your conviction that maybe if you want to be long duration, Europe's the place to be?
I think that you look globally. I think that the 5-year part of the curve looks attractive across a number of markets, including Europe. I think that the global baseline is for soft landing in the US, really quite a good outcome in the US, trend-like growth in Europe, but you're not pricing significant recession risk. It's not our central case by any means, but that 5-year part of the curve, I think, is a good place to be, because in the event of worse than expected macro outcomes, worse than expected market outcomes, that there's room for the rally in that part of the curve. We're broadly pricing central banks getting back towards where their neutral policy rates, the region where neutral policy rates are. That looks about right in the baseline. But you do have that potential for capital gains, lower terminal rates if you do get the worse than expected outcomes.
Andrew, just to build on what John was talking about, there's a belief in some circles that U.S. bond markets, particularly long-term bonds, are going to have a premium built into them because of what you were just talking about, the deficit and some of the fiscal overhang in the U.S., especially when compared with Europe, that certainly has deficit issues of its own, but still is facing a much more disappointing outlook for growth. Are you saying that that's not true, that even though you're worried about the fiscal deficit, it doesn't mean that there's going to be a significantly higher premium on U.S. long-term bonds than, say, those in Europe?
So I think if you look at the US and Europe, interestingly, in both cases, you want to be in the 5-year part of the curve, maybe the 5 to 10-year part of the curve in Europe, and you want to be underweight the 30-year part of the curve. In the US case, that's fiscal risk premium over time. It seems likely if the US is going to keep running 6-7% type deficits at full employment, that you could build in more risk premium, and it would be the 30-year part of the curve where you would think that you really see that. The European case is just the curve is very flat between 10s and 30s, 5s and 30s. If there is US-led global curve steepening, that's going to impact the Europe. That happened in the first President Trump term. And you can make the bullish case on the 5-year part of the curve. So the US, in Europe, the curve steepening position, I think, makes sense. And then markets like the UK, Australia, where terminal rates are a bit high, I think, compared with the US, compared with the history in the UK or Australia, or the estimate of neutral rates. So these look pretty attractive as well. We tend to have overweights in the UK and in Australia in some of our portfolios.
There are two pieces to this. The fiscal side is one of them, and as you've been talking about, the economic piece, very much another. We've been talking about the ECB rate decision coming up later this morning, and a question about how much the European Central Bank is going to have to diverge from the Federal Reserve, simply because inflation is falling faster, but so is growth. Do you see that as a possibility, that that's what's going to happen, that potentially the ECB could cut rates much more quickly than the Federal Reserve and lead to a bigger divergence, at least in the short term, between the US and Europe?
I think it certainly could happen, but remember that the ECB has the single mandate inflation. Look where core inflation is, look where service sector inflation is, look at the wage demands coming out in the German economy. And this is a central bank which I think is going to be not that radical. The pricing, looks reasonable to me, getting to terminal rate close to 2%, maybe more likely to go a little bit below 2%. So I don't have a super strong view on the timing. I think there's some incoherence in their communications. I don't really understand what the point is of guiding you're not going to do something in October and then guiding that you are. So I always think that they could speak less rather than more and let the actions speak for themselves. But I think they're going to go today. It looks very likely that they'll go in December and then into next year. I think the key thing for me is that if they need to, if the data does weaken significantly, then they certainly have plenty of room to cut rates beyond what is priced in. I don't think they're going to be going back to the world of negative interest rates, but they could certainly go to 1% or a bit below, maybe 0.5%. And so I think when you're looking at positioning, in the baseline it looks fine. The yields in Europe are pretty attractive. And in the event of the asymmetric risk, I would agree, of weaker outcomes, then you can benefit if you're in that kind of 5-year part of the curve from the market pricing in lower terminal rates.
Andrew, just before you go, I wanted to squeeze in credit. You've got some great leadership at the firm, including yourself, Mark Kiesel, Dan Iverson. How are you all thinking about what's happening with credit right now, with investment grade and high yield spreads at super tight levels, comparable to some very frothy periods in financial market history? Just what is going on?
So I think in the baseline, credit looks okay. Spreads are tight, but given the pretty positive outlook for the US, I think in the baseline credit will do fine. But you have risks of more negative outcomes. Yes, I think the US labour market looks fine, but when you are slowing down, there's always risk around that. And so I think one thing to do is to be up in quality. If you're in investment grade credit, if you're in mortgages, agency mortgages, non-agency mortgages. If you're looking at high quality spread that will be robust across a range of outcomes, I think this is a better place to be than more economically sensitive parts of the market. So I think we can achieve a lot of what we want to achieve being up in quality investment grade credit. We don't need to have a lot of exposure to high yield credit. You can do some emerging markets, again, have the high quality exposure. So I think this is an environment where yields are very attractive. You can build really attractive portfolios, 5, 6, 7, 7.5% type yields without needing to go significantly down in quality to the more economically sensitive parts of the credit market.
Andrew, appreciate it, as always. Andrew Balls there of PIMCO on the latest in fixed income. Yields a little bit higher this morning, up by 2 basis points on a 10-year, just north of 4%. With an update on stories elsewhere, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. President Joe Biden has marked a new milestone in his effort to forgive student loans. Today, the administration announced that it has approved $4.5 billion in student debt cancellations for around 60,000 public servants. The total of public servants who have received relief now exceeds 1 million since he took office. Nestle has cut its sales and profit guidance for the year, struggling to rebuild market share after higher prices turned consumers off name brands. The Swiss food maker abruptly replaced its CEO last month, shifting from an outsider who had run a healthcare company to an insider who climbed the company's executive ranks. Nestle shares are rising this morning, but are off more than 10% this year. Uber may be considering a bid for Expedia. That, according to the FT, Uber approached its advisors in recent months about a possible acquisition of the online travel company. The ride-hailing giant has not officially reached out to Expedia, and the FT says that there are no ongoing talks between the two companies. Uber CEO Dara Khosrowshahi was CEO of Expedia from 2005 to 2007 and remains a board member. That's your Bloomberg Brief. John.
Danny, thank you. Appreciate it. More from Danny in about 30 minutes' time. Up next on the program, outpacing expectations.
The economy stays more resilient. That should lead to corporate profits continue to move up. And that's been the most stable thing we've seen in this market, right? All the narratives have shifted. The earning trends for corporate America have been the most stable part of this market.
The View from Morgan Stanley Investment Management. Up next. Stocks up this morning by 0.4% on the S&P 500, under surveillance, outpacing expectations.
We're still positive on tech. We still don't think we're in an AI bubble. We still see relative value in the equity market, just because if the economy stays more resilient, that should lead to corporate profits continue to move up. And that's been the most stable thing we've seen in this market, right? All the narratives have shifted. The earning trends for corporate America have been the most stable part of this market.
So here's the latest. Earnings season ramping up as TSMC confirms a continuing AI boom, hiking its revenue outlook after its quarterly results beat expectations. Dan Skelly of Morgan Stanley saying 3Q earnings revisions have been negative for cyclical sectors, but 2025 estimates are being revised higher. This indicates to us that market is thinking about soft landing in 25 and a shift towards earlier cycle beneficiaries. Dan Skelly joins us now for more. Dan, good morning to you.
Good morning, John. Good to see you.
Netflix reporting after the close a little bit later. We won't do single names for you, but the emphasis starts to shift away from the financials and towards some of the media tech type players. How high is the bar for the rest of the market after what we've seen from the financials earlier in the last week?
Well, we've gotten off to a great start, as you know, in the last week with banks and even seeing some of the consumer plays as well. So the bar is high, Jonathan, and one thing we've been talking about is respecting that rotation since July and August. It has been fairly consistent since then that you've been seeing the value in cyclical sectors responding better to their earnings results.
The tech story's been a mess. I think this week's a fantastic example of that. ASML drops, everyone's spooked. TSMC comes out, everything's okay. Where is that trade now?
It is a mixed bag at the moment. It was the only game in town for 18 months. So you're seeing the broadening out of earnings into other sectors. We talked about financials. Industrials is certainly another place. Materials. Let's see what happens with China, which I know we'll get into, but we're seeing better global growth potentially. So the reality is it is a higher bar. It's a mixed bag. The Magnificent Seven itself has gone almost to like the Dynamic Duo or the Dynamic Two. So things have certainly changed.
Yeah, well, you talk about the idea of growth outside of the U.S. and you talk about China, and yet you've been telling people not to buy into the Chinese equity rally. And frankly, it's probably based on today's action, which is one day. It seems to be where the mood is shifting. How much can the rotation continue if all of the pillars don't hold up? You have the earnings, you have Fed rate cuts that people believe will be cutting down the pike, and China stimulus. Can you get some of those fall away and still have the rotation theme?
It's a really, really good question, Lisa. And in particular, we think as it pertains to the U.S. leadership in large cap value, Fed cuts, more confirmation about a soft landing. We've seen that in services, but do we need to see more in manufacturing? Yes, manufacturing has lagged, so that's still to come. And then it's the earnings broadening out. So we think if you have enough domestic drivers, that can still power the U.S. trade. You're not necessarily as reliant on China continuing to follow through with stimulus to get that trade to work.
How excited can you be outside of the U.S., and I'm talking about Europe in particular, if you don't have China cooperating?
You got to pick your spots. I mean, look at some of these countries like Germany as an example that's been entirely reliant on autos for a long period of time. So not only are there cyclical pressures there are structural pressures there with changes in the industry, with competition, new technologies. And so I think there's a lot of more bottom-up idiosyncratic risk to those places than maybe most people discount.
Dan, let's talk about the geopolitical and domestic politics. These risks, you say, are over the market. When you talk about the U.S. election, you say the passing the election will be a clearing event with downside volatility. What about if there's a contested election?
So notably, Anne-Marie, we didn't say election night, so we do subscribe to the fact that it will be more of an election week. So once we get past that week, we do think that it'll be a risk-clearing event. We will accept a winner. And what's notable, and we've talked about it over the last several months, the market continues to climb this wall of worry. We think the election's one component of that. 2 years ago, it was trying to disprove the recession. A year ago, it was what was the path of the Fed? Would they be proactive or reactive with rate cuts? We think the election's the last rung on that wall of worry.
But what if there's a Florida recount issue? What if it's that kind of contested election?
It could certainly be a higher volatility environment, but we do think that it's going to be short-lived.
You can't wait to see the back of this, can you?
Cannot wait.
I can feel it.
Cannot wait. I think we're all in agreement on that, possibly.
Is that wishful thinking? Do you think this is that typical election that once the event is cleared, we're back to business? Or could we see some serious changes to policy that we all need to pay attention to?
Well, it's an excellent point, and not to diminish the gravity of the moment. I think the one scenario that does present the most near-term volatility is that red sweep scenario, which is over the last week or so been increasing in terms of the betting odds. Why is that more relevant? It's relevant because in Trump 2.0 with a red Congress, debt to GDP is 30% higher than it was in 2016. Interest rates are way higher than they were back then as well. It's a different backdrop. And so the idea of doing all this fiscal expansion, tariffs, extreme trade policy, and potential changes to immigration policy, all of that throws a real wrinkle in this Goldilocks soft landing disinflation thesis.
Dan Skelly, appreciate your time, sir.
Thank you.
Could see some big changes. Dan Skelly of Morgan Stanley Investment Management. Up next on the programme, in a second hour of Bloomberg Surveillance, we'll catch up with Mohamed El-Erian of Queen's College, Cambridge. We'll speak to Terry Haines of Pangaea Policy, Ken Tropin of Graham Capital Management, and Herman of Bloomberg Intelligence, looking ahead to more earnings from financials with a focus on the regionals. From New York, this is Bloomberg.
Technicals are fiercely strong.
The amount of liquidity in the markets is phenomenal.
I still think you're going to get the best juice from the equity market.
You're seeing it, stocks and bonds are trading uncorrelated.
It probably is far more uncertain for bond investors than it is for equity investors.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
technicals are fiercely strong.
The amount of liquidity in the markets is phenomenal.
I still think you're going to get the best juice from the equity market.
You're seeing it, stocks and bonds are trading uncorrelated.
It probably is far more uncertain for bond investors than it is for equity investors.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now, live from New York City. Good morning to you all. This is your morning this morning. It looks like this: 8:15 Eastern Time, an ECB rate decision, 8:30. Jobless claims, US retail sales, 8:45. President Lagarde speaking, an ECB decision, Lisa, just around the corner.
There are two different and diverging themes right now, which is strength among the U.S. consumer, which we may get highlighted today at 8:30 a.m., and weakness in the Euro region that the European Central Bank is going to have to respond to with rate cuts. Those two stories have led to divergence. They've also led to the rotation theory that we've seen play out in the U.S. Can they continue? And where is the balance of risks is my question.
It feels like they need to continue. You look at what happened this morning when it comes to the European Union inflation, revised down. You look at what Christine Lagarde said in July when she talked about the jobs market as a reason the ECB could, quote, take time to gather new information when they're setting policy. Has time run out when you look at the labor market that is developing right now in Europe?
Look at what Andrew Balls of PIMCO said earlier on this morning. You go to Europe for bonds. Why'd you go for Europe for bonds? Two reasons. Growth's not great, one. ECB is going to have to cut interest rates because of that. Two, you've got the risk of the walls going up in the United States of America, putting tariffs on the Europeans that could damage growth even more. So there's two risks there that ultimately you double down on a long in European debt, potentially. Just an argument. You come to the United States for equities, particularly if Donald Trump gets a red sweep, the walls are going up and they're turning up the heat domestically. So that growth you'll see in America is going to be all contained in the United States of America. That is not going to bleed out to the rest of the world.
And this raises the question of whether American exceptionalism is going to continue being a theme in terms of equity performance, or whether you start to see that diversification, that broadening out in a more material way, and you can feel that tension right now being played out in a number of different regions.
This is all scenario analysis for 2025. We need to deal with Q3 of 2024. More earnings still to come. Going into Q4, we're looking at equity futures right now, up by 0.4% on the S&P. On the Nasdaq 100, we're up by 0.8%. Some outperformers from tech this morning. TSMC, Taiwan Semi, Lisa, better than expected, a beat and a raise.
Which raises really basically a contrarian view to what we saw from ASML that came in highly disappointing with future orders coming in below expectations. This goes down again, and we keep talking about this. How much does it show that basically the semiconductor industry is a fate of two different worlds, those exposed to AI and those that aren't? Or is this really having to do with where are your business customers? Are they in China? Are they in the rest of the world? And ultimately that will make the difference.
It's a very good point. Their stock is up in a pre-market by a little more than 8%. Coming up this hour, we'll catch up with Mohamed, El-Erian of Queen's College, Cambridge, on the Fed's data dependence, Terry Haines of Pangaea Policy, as Kamala Harris distanced herself from President Joe Biden, and Herman of Bloomberg Intelligence with regional bank earnings on deck. We begin this hour counting you down to the data of the week. It's retail sales and jobless claims just around the corner. Mohamed, El-Erian of Queen's College, Cambridge, writing the following: excessive data dependency has contributed to volatility not just in the Fed's forward policy, but also actual policy steps. Hopefully, the early signs of a Fed shift combining data dependency with a more strategic approach will take hold. Mohamed joins us now for more. Mohamed, welcome to the show, my friend. Are you seeing evidence of that shift already taking place?
I think I am, and I'm hoping that I'm not too hopeful. And there's reason for that, John. They got hammered on the issue of data dependence in the Wall Street Journal. And just think, at end July, we didn't need a rate cut. Mid-September, we needed a 50 basis rate cut. And now we're talking about caution on rate cuts. That's huge volatility from a policymaker that is supposed to set guidance for not just the U.S., but well beyond the U.S. So I think there's a realization that it's time to get out of this data dependency. And you heard it. You mentioned the word recalibration. And if you look at Chris Waller's comments from earlier this week, I also sense it there.
He also brought up the October payrolls report that drops on November 1, Mohamed, and the prospect that we could see some really distorted data. And it raises a different question, one that you and I have talked about for years. When you talk about data dependency, how dependable is the actual data that we're about to get?
No, that's the problem, is that the revisions not only change the numbers, sometimes they change the whole interpretation. And that is one of the problems with data dependency, with excessive data dependency. Look, I'm not saying don't take data into account. I'm saying don't make it the main determinant, in fact, the only determinant of policy. That's where you make mistakes. The Fed is shy about being more strategic because of the huge mistake they made in 2021. But you don't add to that mistake by making another mistake. And I do think they're going to emerge from this period of excessive data dependence.
Mohamed, one thing that you've said in the past is, yes, you can try to parse through this unreliable data, but listen to what companies are saying. Listen to CEOs and CFOs, and we've been listening. And frankly, all of the bank CEOs and CFOs are telling us that the U.S. consumer is incredibly strong, whether it's PNC and U.S. Bank or whether it's JPMorgan. Is there something that's emerging here that's not muddy, that's not confusing about the strength of the U.S. consumer?
Yeah, what's emerging, Lisa, is that the weakness is concentrated and not spreading. It is concentrating, unfortunately, in the lower income households, but it is not spreading. And that is what you're hearing from company after company that serves the whole of the income distribution. Those who serve the lower income, the lowest income, have a different music, if you like. I mean, it's a different mood music that for unfortunately the people who are most vulnerable. When we look at retail sales today, we also need to figure out how are these retail sales being funded? Are they being funded out of current income, or are they being funded out of debt and out of rundown in savings? Because that's going to be important as well looking forward.
Especially at a time, Mohamed, where we saw credit loss provisions actually increasing in a lot of the banks, and people view this as them preparing to actually ramp up lending, to take more risk, to really meet the demand, to continue to fuel purchases. What do you think the risk is that financial conditions have loosened incredibly far beyond what the Federal Reserve has indicated, to a level where you could see really a reacceleration on that front? Or do you think that's really kind of a moot risk?
So two things. One is I think that part of the provisions also reflect the stronger than expected outcomes. And you sort of keep a buffer for later on, and then you can release it when there are earnings pressure. So I don't attribute all of the provisioning to concerns about credit. I do think part of it is just a strategic buffer, and it makes total business sense. In terms of financial condition, you heard it in the introduction to your 7 o'clock hour, They are extremely loose. We have right now not only the factory of private sector creating a tremendous amount of credit and leverage, we actually have the public sector creating a tremendous amount of leverage. You know, Andrew Bowles made the correct point that at full employment, we're still running 6 to 7% GDP deficits. That's incredibly stimulative in this environment. So yes, financial conditions are incredibly loose due to both the private sector factories of credit and the public sector factories.
Mohamed, this raises a really important question. It's about the difference between the approach the Federal Reserve is taking and the ECB. The Federal Reserve seemingly, comparatively, has a much better backdrop for growth, has much looser financial conditions, as we know, much more financing goes through the markets and not the bank channel compared to, say, Europe. It just begs the question, Mohamed, why we're having this very different conversation around the ECB, why we're sitting here saying 25, but I've got no idea what comes next, and they're going meeting by meeting, and the Federal Reserve saying recalibration 25 or 50 seems to be the debate on the street. What explains that difference?
I think part of what explains that difference, John, is the different experience of Eurozone members with inflation. I'll give you an example. We had the numbers fall today. 1.7 for the Eurozone as a whole. But look within that, Belgium 4.3, Netherlands 3.3, and at the other end, Spain 1.7 and Ireland 0. So, you know, it's hard if you're at the ECB because you are making policy for countries that are in different situations. But I do agree with the notion that the market right now, and I put out a chart on this on X, that the market right now is pricing the same amount of cuts from the ECB and the Fed. And I don't think that's what's going to happen. I think you're going to see the ECB cut more than the Fed. And I agree with what Andrew Bowles said about the attractiveness, not just of European, German bonds, but also of UK gilts.
Do you think the ECB needs to be making a decision, though, based on what is going on in Germany specifically, their manufacturing base that is basically on the edge of shutting down shop factory doors?
Yeah, I think they do. I think they have to take that into account. Germany is the traditional locomotive of growth for Europe. But, there was a lovely title saying the problem child of Europe is Europe. And if you look at the Draghi report, it really does bring out all the structural weaknesses and structural headwinds that face Europe. And if I were the ECB, I would take that really seriously, because it will at some point feed into price formation.
Mohamed, unlike the United States, it just feels like there is this self-imposed debt brake taking hold across the whole of Europe. And it goes beyond the UK. I look to France and I look to other places too. Italy's doing better, but they seem to have this more prudent, pragmatic approach to debt issuance over the last several years. Even they have become somewhat more conservative. What's behind that, Mohamed? What is driving that force, those forces across the continent?
And this is a very active debate in the UK right now. Look, simple rules change behaviors. Any parent knows that. And in the case of debt, we got a whole set of simple rules to change behaviors on debt. Now we've got to the point where these simple rules are not only too simple, they're counterproductive. So you're starting to get a debate on the appropriateness of fiscal rules. And three things in particular, John: the definitions, the time horizon, and whether you should treat investment the same as current income, current spending, given that they have very different effects on the economy. And that debate actually will see the UK lead the way. So I strongly suspect that in 2 weeks' time, we are going to see some significant revision to the fiscal rules in the UK, and then the focus is going to shift to Europe.
Mohamed, if the rules stay in place, or there is this constraint on debt, what is the chance that in 2 years' time, 3 years' time, the ECB is going to be fighting disinflation and deflation once again?
High, Lisa. Really high. Structurally, this economy is going to not just slow, but risk getting stuck in a very low level equilibrium. So yes, that risk is high. But the ECB will rightly say, and I agree with what I'm sure President Lagarde would say, is it's not the ECB's job. This is the job of governments, both at the domestic level and at the regional level, because you need fundamental structural reforms to put Europe back on a path of high and durable growth.
Mohamed, this was a clinic, sir. It's good to hear from you, as always. We won't mention the Mets. I just mentioned the Mets. Forgive me for mentioning the Mets.
Oh.
That hurts, John. That really hurts.
Come back soon. When they win, they're going to win.
Honestly.
There's still more games to play, right?
8-0.
All I can say is, Mohamed, if you still hear me, I like your tie. And you know what? I'm just going to keep talking over Anne-Marie. I'm just going to repeat this. Yeah.
Who's that? Yeah, you know.
All right,
Mohamed,
whatever.
thank you. Mohamed El-Erian of Queen's College, Cambridge. They might win the next one. Let's give you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The trading desk at Goldman Sachs says that the S&P 500 can go beyond 6,200 by the end of the year. The index has already set 46 closing records this year. The team says the rally is primed to continue. According to Goldman's calculations, which factor in typical election year returns, the S&P could reach a figure of 6,270. That number becomes a new street high, topping the previous bullish forecast of 6,100 from BMO. The EU is warning X that it might calculate fines against it by including revenue from Elon Musk's other businesses, like SpaceX and Neuralink. The EU has been investigating X for breaching the Digital Services Act. Fines for violating that act can be as high as 6% of global revenue. People familiar told us that the EU may consider in that figure all of Musk's companies. Meta has fired about 24 staff in LA for abusing the company's food credit system. According to the FT, Meta fired staff who used their $25 meal credits to buy household items like acne pads, wine glasses, and laundry detergents. Some had also been pooling their money together or getting meals sent to their homes. Elsewhere, Meta said that they made wider company layoffs as part of a restructuring. And that's your brief, John.
Danny, thank you. Appreciate it. More from Danny in 30 minutes. Up next on the program, pressure rising on the campaign trail. Live from New York City this morning. Good morning. Live from New York City, plenty to get through this morning. 8:15 Eastern Time, an ECB rate decision. 8:30, lots of data, jobless claims and US retail sales. Equity futures on the S&P 500 near session highs, up by 0.4%. Under surveillance this morning, pressure rising on the campaign trail.
We want workers and we want them to come in, but they have to come in legally. They have to love our country. They have to love you, love our people. The problem with this administration is they've totally lost control.
We've had a broken immigration system transcending, by the way, Donald Trump's administration even before. Let's all be honest about that. I have no pride in saying that this is a perfect immigration system. They need more resources, and Congress ultimately is the only place that's going to get fixed.
So here's the latest. Trump and Harris ramping up the rhetoric in high-profile interviews through the week. Terry Haines of Pangaea Policy writing, neither Harris nor Trump hurt or helped themselves in interviews. They didn't move the needle either way in this still neck-and-neck race. Terry joins us now for more. Terry, welcome to the show, sir. It's good to catch up as always. The Harris campaign has taken a few more risks, particularly the one they did yesterday afternoon. Is it paying off?
Oh, I don't think you'll see much movement either way. I think Harris out there live and contentious is generally speaking, is a benefit for her. I think Trump, seeming as he did on Tuesday in your interviews, relatively cool, also helps him. But it's not going to move the needle in a world where there's basically neck and neck race, and it's been neck and neck for the last 3 months.
But say it was to move the needle slightly. I imagine she was going after those Nikki Haley Republicans that potentially she can bring over to her side. Did she do it justice last night?
On balance, I don't think so. I mean, did she make that particular sale? I don't think so. I mean, she probably made some inroads, but the passion on some things, particularly Trump's unfitness for office, to a Haley voter is also balanced off against the hash that she makes of the immigration issue. And I get why she does that. She's trying to be loyal to her administration, and at the same time, try to provide the view that she might do something different, or is inclined to do something different. But at this point, she'd be better off cutting Biden dead on a lot of this stuff. But that makes her look impotent in the administration. So it's a no-win situation for her, and the interviewer knew that.
Right. She's in a rock and a hard place when it comes to the fact that she is the sitting vice president and her president is Joe Biden. It begs the question, though, Terry, she did have a good performance last night, whether you agreed with her answers or not. Do you think that she is evolving as a candidate and potentially the Democrats did not do her justice by not providing her with a primary?
I don't think it's really the primary. It's that, she came off when she became the candidate. I think it's far too much the tool of the party regulars. Too many decisions that have been made in the Harris campaign have been designed to placate the base, to shore up the base, to deal with the base. Far fewer have been meant to actually reach out to those undecideds and bring them on board. Yet that's the fundamental campaign strategy. She's finally doing that, I think, a little belatedly, and but she's also making a lot of mistakes. She goes to Pittsburgh, a little blue dot in the middle of a Red Sea, and doesn't venture out 15 miles to actually go see fracking, go understand what that's about, and have an opportunity to trumpet her view. She's not going to the Al Smith dinner tonight, which I think is a huge fail on at least three counts. So there's a lot of campaigning here on Harris's part, where she'd do a lot better if she was listening less to her own campaign people, I think.
She's also not showing up at the Economic Club of New York nor the Economic Club of Chicago. She might, though, Terry, she might go sit down with Joe Rogan. Do you think that could potentially help the Democrats as they try to make this bid for more men to come out and vote for them?
I think it depends on how willing and how much fire she's willing to show, and how willing, there's a lot of talk these days about authenticity, which is itself a construct, but how authentic she's willing to be with Rogan. I mean, if she can, actually have a good, serious, substantive conversation with Rogan, I think that does help her a little bit. But if it's tentative and it's designed to kind of, hit polling memes or phrases, it's not going to work well.
Terry, when we talk about the state of the race, a lot of people point to polls that are neck and neck. And right now, as Dan Druckenmiller pointed out, the market is basically pricing in a Trump victory and potentially, increasingly, even a red sweep. Does that cohere with the polls and how you interpret them?
Well, it's, I see the sentiment, and the sentiment exists on no evidence. There's not contrary evidence, but all this talk of Trump momentum, Trump this, Trump that, is based on on polls that usually have 3 to 4 points of margin of error. I mean, you all know this, but the back and forth here over the last month is, if you look at the two-way national, there's been a Trump 0.3% swing in 1 week, poll of polls, and in 1 month it's been Harris 0.5, so net two to Harris. Whatever that is, that's not momentum. Those are rounding errors, and people ought to deal with them accordingly. But then, prediction markets aren't polling either. They're sentiment markets.
At this point, though, it does seem like it's a pretty razor-thin race, and I just wonder how messy things could get, especially with the lawyers lining up and everyone expecting this to be election week, election month, election next 3 months, whatever it end up may being.
Well, I think it'll get a little messy, and it's not just the lawyers either. I was struck by something I saw coming out of Pennsylvania yesterday, where that purported to show that Pittsburgh could deal with all of its mail ballots and count them on election night, but yet Philadelphia couldn't. And I just laughed because, of course, in the old days, machine politics, you'd hold back, say, Cook County in Illinois until the rest of the state came in, and then you'd produce the votes you needed to make sure that your candidate won. But there's people have, it's not just the lawyers. People are fumbling the ball all over the place here, and not least of which election officials. They've done very well in a lot of places, but you're going to see these hiccups and these outliers for a few days to come, particularly in a race this close.
We've got to do a lot better than that. Terry, appreciate it. Terry Haines of Pangaea Policy. We've got to make some changes. Just on the interview, I consider Bret Baier to be like top of the pack, right up here in terms of broadcast interviewers here in the United States of America. And I think she did a pretty decent job. And I think you've got to separate style from substance. When it comes to substance, it's often going to be in the eye of the beholder. It's always going to be subjective. There'll always be people that'll be unhappy. And when it comes to immigration, I think immigration is to the Harris campaign what January 6th is to the Trump campaign. They just haven't got a good answer for it. And they're never going to give you the answer they want. So just to focus on style. Softball interviews have brought out the worst of her. She makes very simple mistakes to very, very simple questions. I think these hardball interviews are bringing out the best of her. I felt like she'd really researched for this conversation in a way that I'd never had that feeling or sense before from listening to tons of conversations the vice president has conducted with over the years. And she has a very simple tactic. And we saw this on show in a much bigger way in the last election cycle with Vice President Pence, when she said, "Let me finish." And when she says, "Let me finish," I think it's almost impossible for the interviewer to speak over the top of her. It enables her to filibuster. And I still haven't seen a good broadcaster find a way to counter that. Because often what she's doing when she's saying, "Let me finish," is not answer the question that was asked in the first place.
No, and it's a very good tactic. And she used it almost immediately, which meant that Bret had to almost tone down how aggressive he was being in the short amount of time he had to get to answers that he wanted. It was a tactic. I also think there is a gender issue with that. I think when you're a woman and you say to a man, "I'm trying to finish," as she did with Mike Pence, as she did with Bret Baier, it works.
I hope we see more of this. I really do. I hope we see more of those kind of robust conversations through the cycle. Coming up on this program, we'll catch up with Ken Tropin, the founder and chairman of Graham Capital Management. From New York City, equity futures higher by 0.4%. The data's about an hour away. Jobless claims and retail sales, 8:30 Eastern Time. Your bond market yields higher, just north of 4% on a 10-year. Live from New York City this morning. Good morning to you all. 1 hour away from economic data in America. Jobless claims and retail sales. 60 minutes after that, the opening bell. Going into all of that, equity futures on the S&P 500 firmer by about 0.4% with some morning movers. Let's cross over to Danny Berger. Hey, Danny.
Hey, John, starting you off with some deal news. Overnight, the FT reporting that Uber has expressed interest in buying Expedia. Now, they haven't formally approached them. This is just talks with advisors, according to the reporting, but this is a desire to become the everything app, a super app, kind of like WeChat in China. We know Musk has aspirations for that too, but that sent Expedia shares higher by 6.4%. Uber shares are lower on that news. Some earnings from Alcoa. This came after the bell yesterday. The miner reported a really stellar set of results, their best set of results in more than 2 years, all thanks to the price of alumina moving higher. It's moved higher by 45% this year because of supply constraints, so the shares of the company up 6.6%. Finally, the whipsaw of tech. This morning, it's a positive story. Earlier this week, it was a negative one from ASML. It was TSMC reporting in the Asia session that they had a really strong quarter, upgrading their forecast, saying that there is just extreme demand for AI chips. So this morning, it means that tech can rally. NVIDIA up just under 3% on that, John.
Danny, thank you. We'll touch base with Danny again in just a moment. Under surveillance this morning, US stealth bombers striking weapons storage sites in Yemen linked to Houthi rebels. The latest effort to diminish attacks on Red Sea shipments by the Iran-backed group. Defense Secretary Lloyd Austin saying the strikes hit 5 hardened underground facilities.
And he was out with a statement last night saying, the Defense Secretary Lloyd Austin saying this is a unique demonstration of the U.S. ability to target facilities that our adversaries seek to keep out of reach, no matter how deeply they buried. The question becomes now, why did they wait so long? American intel officials said Houthi assaults on commercial vessels in the Red Sea led to 90% decline in container shipping through the area between December and February. So everyone who said that more needs to be done in terms of taming these individuals, especially what is going on in the Red Sea, why are they waiting till now?
They have been doing a number of different attacks on Houthi military sites, but not with bombers. And this is the first time that they've used equipment that actually can get to underground facilities. You just wonder whether there's sort of watch what they do, not what they say, a sort of ratcheting up, especially with a multi-front kind of attacking capabilities in terms of some of the proxies to Iran.
The military might of America is pretty impressive. The stealth bomber, doesn't it just look incredible? Every time I see that, it's just phenomenal.
Do you watch Top Gun?
Of course.
So is this sort of like, on repeat?
Also, they're using the stealth bomber at the same time that they brought the THAAD into the region. I cannot get over this piece of equipment that they have now moved to Israel. We have never seen this before, and this is serious piece of technology that I think would likely have Iran and its proxies on guard.
Big changes, big changes. I want to get you the latest on Boeing. Reuters reporting Boeing is looking to raise $15 billion in a sale of shares in a mandatory convertible bond. The plane maker announcing steps to raise as much as $25 billion in a filing earlier this week. Boeing is looking to repair finances with an ongoing cash drain and worker strike. That stock down just a little bit here, Lisa, down a third of 1%.
Have we ever reported news in the past couple of months with Boeing shares higher? I'm serious. I ask this because it seems like every drip feed of information is just worse and worse. At this point, this is pretty much expected. They were going to have to raise money. And so the question was just when, whether potentially some of the threats to cut staff really came ahead of that to try to shore up support. But really a question continues. How are they going to get out of the doom loop?
More bad news. And now it's been more than a week since the latest contract negotiation between them and the 33,000 workers have basically blown up. They walked away from that from both sides. Acting Labor Secretary Julie Su was there. She's trying to get them across the finish line. But right now, on the surface at least, it seems like there is no movement when it comes to Boeing and when it comes to labor unions.
So I'll get you some good news from the FTC. Finalizing a rule requiring companies that sell subscriptions to make them as easy to cancel as they are to sign up for, with the click of a button or just in a few steps. This came from the chair, Lena Khan, saying the rule will end, quote, trick and traps and save Americans time and money. The reason I say good news is because I feel the same way about subscriptions. Why are they so much harder to cancel than they are to sign up for?
Well, I don't know. They're on the bottom usually of every website that says cancel. I agree. This is going to poll really well. This is a good issue to come out for if you're an incumbent before the election. The White House celebrating the move yesterday, saying unwanted subscriptions add up for Americans and our administration is taking action to save time and money.
I can't mention a company now, but I've got one subscription. It's fitness related. I've got no idea how to cancel it. And it renews, I think, in about a month. and I've got to work out how to cancel this thing.
I have a couple of those too.
Right?
And you actually, but wait, basically you have to call, and then they say it's better for you to pause and freeze, and you say I don't want to, and they say but you need to fill out this form explaining why, and then you can pause it, and you say no, and then they start giving you hell.
This is what the newspapers
exactly.
do. They make it easier to pause than to cancel. So you like pause it for 6 months.
Right, exactly, and then it starts up again,
and
then
the papers arrive.
Why are you canceling a fitness subscription?
It's a very, very particular piece of hardware that you wear on your wrist, right? And I'm not happy with the data it brings, and I don't think it does a good enough job.
All right.
Does that make sense to you? Or are you suggesting that I'm not working out anymore? Is that where this is going?
Yeah, I was just wondering if you were...
Okay, good. I'm pleased this is getting really personal. Investors preparing for diverging paths after the US presidential election. Ken Tropin of Graham Capital Management wondering what he's doing here, finding a common thread, writing this. This is what he's got to say. Given neither Trump nor Harris is fiscally conservative, we expect the yield curve to steepen no matter which candidate wins. Ken, thanks for being here, and thanks for sitting through that as well. It's good to see you.
Nice to be here. Thank you.
Let's get to this bond market. How are you thinking about treasuries if either candidate wins in November?
So, we have to start with that neither candidate is a fiscal conservative. And neither party has shown, much enthusiasm and or attention towards the deficit, right? So I think no matter which candidate ultimately prevails, the long end of the fixed income market is vulnerable because the deficit is just growing and growing and growing, and the interest expense associated with it is, the elephant in the room that eventually the markets are going to start focusing on.
We're running a deficit of GDP of about 7% at a time when unemployment's around 4%. How unheard of is this in American economic history?
We've been kicking this can down the road for a very long time. And, fiscal conservatives have been run out of politics. So it's one of these things that I think it's, the sleeping giant that at some point the market psychology will pay attention to it. There will be some event, and I can't say what that event will be, that will provoke attention to it. And I think it'll matter, but we're not there.
Well, as a macro hedge fund, the sleeping giant has been asleep for 30 years. And so it raises this question, how do you position for a catalyst that may or may not come, and that it's unclear when it will come, even if the facts are correct?
Great question and a hard answer. So, you can't trade today on what might happen in 9 months. We're much more short-term than that. So we've got to really focus on the short-term factors influencing the market and try and tactically trade around those factors. And, think about the last Fed meeting. I can't remember the last time the Fed went into a meeting where were they going to go 25, were they going to go 50, and it was like 60-40 that they would go 50. But that is so close to a coin flip. We haven't had that in 15 years. So the market in fixed income is definitely volatile and interesting, certainly for us who focus on rate trading.
So how do you play that, right? Where it is sort of a coin toss. Do you take a view, or do you basically?
We did have a view. We had a view that they were going to go 50. We turned out that view was correct. We played the steepener trade that worked for a week or two, and then the strong data came out, and of course people were forecasting potentially a 50 basis point hike or cut again. That, of course, got priced out pretty quickly. So, the markets are really moving a lot, and it's not always easy to get it right for sure.
Ken, we want to understand the relationship from your standpoint between bonds and equities. If yields are going up because the data's better than expected, the equity market seemingly can handle that. If yields are going up because of deficit issues and pushing back against policy initiatives of politicians down in Washington, D.C., how constrained will equity market gains be over the next year or so?
Because investors and their psychology, and psychology is so important in the mindset of institutional and high net worth investors. Stocks have gone up for 15 years. Everybody's been trained to buy the dip. Every time equities sell off, people have been told this is when you should get in. And so I think that provides some momentum and some upward pressure on equity prices that is pretty hard to overcome no matter what the fundamentals might really be.
So if we got a red sweep, sell bonds, buy stocks?
I'm not sure. Look, we know that Trump was going to really try and push Powell to lower rates, right? So I don't think the short end is necessarily going to go up. I think the short end is going to reflect lower short-term yields. I think the market likes Trump as a pro-business, equity play. So I would expect that equities would generally move higher. I think what we're not going to know the day of the election is who won. Well, all these mail-in votes, we're probably going to be looking at a week or two of uncertainty, and that probably isn't so great for equities in the very short run.
We might know the composition of Congress, though. How are you thinking about spending potentially next year, regardless of even who's in the White House?
I think both parties are going to spend like crazy. I mean, so if you're a fiscal conservative, I think you can expect that that's not going to really move the meter that much. Who wins? I mean, Harris has not really articulated her economic platform, so we assume it's Biden's, right? It's not probably going to be that different from Biden's. We know what Trump wants to do, right? Some deportation. He wants to have less regulation. He wants to cut taxes. So, there's a plausible case to be made that that's a pro-equity risk-on, point of view. But, a lot to be seen in, between now and then.
Kamala Harris aide, I'm sure, is going to email me and tell your guest that there's 82 pages of her economic policy on her website right now. But back to this idea of the deficit. Trump borrowed $8.4 trillion. Biden almost $4.5 trillion. Do you have an idea of whether or not Kamala Harris or Donald Trump would be worse or better for the deficit?
I would say it's a pretty close call, right? I mean, it's pretty hard to know, and it really depends on what happens in Congress, right? So it's not just the who wins this election. It's what happens in Congress.
That sigh reflected what we all feel, which is let's get on with this and sort of be past this period of time, and we just want to stop talking about it. But there is this question: if you're a macro hedge fund that's looking shorter term, how do you play it? How do you start to figure about how to take advantage of the volatility that's inevitable?
Well, when things get really mispriced, that's a good time to sort of get involved and say, we have some conviction that this is not going to happen. And for example, recently we've had a long dollar position. We're talking pretty tactical the last few weeks, right? And that's starting to work out a little bit. But right now, I think the best thing a macro fund can do is be pretty guarded about risk. This is a volatile time. The uncertainty is at very high levels. It's not a time to get all down on your skis and say, I'm going to go as fast as I can. You just have to manage risk and wait for higher conviction opportunities.
What's fascinating to me, based on what you just said, is that risk has a very different profile today than it did, say, 10 years ago. And that risk might lie as much in the bond market, if not more, particularly longer-term treasuries, as it does in equities. Mm-hmm. How are you thinking about what risk means and how to mitigate it?
Well, we think about it. What we do at Graham is we meet every morning at 9:30 and talk about every position we have on, what the markets did overnight, how our positions have changed, what stresses are in the market. Is there a liquidity problem that we have to be focused on? And it's not a particularly long meeting because we do it every day and have it for, something like 15 years. And I think it puts us in a pretty good position to know where we have to be careful. And if a particular trader or one of our quant systems is not doing well, we're very attuned to that. And if we have to take action, we do.
Can I just say that 9:30 is a much more reasonable time for a meeting? Can I just say that? As
You're
opposed to
I
think we all agree on that.
Yeah, I think we all agree on that for sure. Before you go, you do a lot of work with the Robin Hood Foundation. Can we just finish there? Walk us through some of the initiatives that you're focused on this year.
Sure. Well, Robin Hood every year deploys about $140 million in poverty programs, poverty fighting programs. And I've been a board member for about 8 years. And it's just remarkable when you see the effect that this has on people's lives that are less well off than any of us. And, for me, we have a hero's breakfast late in the year, it's around Thanksgiving every year. And it's just amazing to hear these people talk about how these programs changed their life and allowed them to get out of poverty and, and be successful. So for me, I think about how fortunate I am running a hedge fund in finance, been successful for a while. And I find that it's this weird thing. The more I give to Robinhood, I feel the luckier I get in life. And so it's just it's one of these unbelievable causes. For 36 years, I've supported Robinhood, been on the board for about 10, and the amount of great work the organization does, and they do it in such a business-like fashion with investment principles sort of funding all of the research into what programs to support. It's been phenomenal.
Well, we're lucky today to get some of your wisdom. Thank you, sir.
Thank you very much for having me.
Thank you. Ken Tropin there of Graham Capital Management. From New York City, equity futures right now just about firmer on the S&P by 0.4% with an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Apple's canceled Project Titan had some help. The tech giant secretly worked with Chinese car maker BYD around 2017 to create a long-range EV battery system using lithium iron phosphate cells. Apple spent about $1 billion a year over the last decade on its car project before ending it in February. BYD's cars are powered by the Blade system, which uses a battery pack that, according to sources, was informed by lessons from the work with Apple. Despite a solid earnings season for the biggest U.S. banks, McKinsey says that the best times may be over. In their annual State of the Industry report, the consultant said that recent improvements could prove fleeting. I caught up with the partner behind that report.
There are some forces at work that do not necessarily favor banks, structurally speaking. They include the interest rate environment. They include the increased spending on tech, AI, data, and things like that. And it includes forces from outside the core banking sector. So private credit, for example, shadow banking, stuff like that.
Pradeep Patiath there speaking with me on this morning's Bloomberg Brief. The New York Liberty led the Minnesota Lynx 2-1 in the WNBA Finals. Star guard Sabrina Ionescu made a three-pointer from 28 feet with a second remaining, putting them one game away from the championship. The next game is Friday in Minnesota. The Liberty have appeared in the finals 5 times before, including last season, losing each time. And that's your brief. John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the program, the regionals in the spotlight.
We're going to see a slew of regional bank reports over the next 2 or 3 days and into next week. And we do expect to see a continued better than expected performance.
That conversation just around the corner, live from New York. This is Bloomberg. Mohamed El-Erian on this program about 45 minutes ago, making the point that he believes this ECB over time will cut rates a whole lot more than this Federal Reserve. We're looking for another rate cut from the ECB in about 25 minutes time. The euro going into that 108.66, south of 109, totally unchanged on the session. Equities just a little bit better than expected, up by 0.4% after earnings come in better than expected from the financials, and overnight TSMC. Under surveillance this morning, it's the regionals in the spotlight.
We're going to see a slew of regional bank reports over the next 2 or 3 days and into next week. And we do expect to see a continued better than expected performance. Asset yields will come down, as you know, but they're not going to come down, we don't believe, as fast as funding costs. So the regional banks, which rely on net interest income to a greater extent than the diversified banks, should do quite well in this environment over the next 12 months.
So here's the latest. Regional bank earnings in full swing on the heels of a strong showing across the board from the larger financials. Investors eager to see the impacts of lower rates on the smaller lenders. With us around the table, Bloomberg's Herman. Herman, good to see you.
Thanks for having me.
Had a few names report already. Yeah. Can you share some of those names with us, and what's the early takeaway?
Yeah, so a number of banks have already reported. U.S. Bank, PNC. Today we've got a number of them. Mgmt, Truist, KeyCorp, Huntington. I would say across the board things were really solid, as Gerard had noted earlier. Net interest margins are starting to expand at this point of the rate and economic cycle, and that's really good to see. Loan growth really hasn't materialized, but because of the margin expansion, we're seeing better net interest income.
Just help our audience understand the relationship between the regionals and interest rates. We know how much it hurt them when they were going up. How much is it helping them now they've started to come down?
Yeah, I would characterize it as more of a yo-yo effect. So a couple years ago when the Fed started instituting rate hikes, that really helped net interest margin and interest income. Last year with the regional bank turmoil and SVB and a handful of other regional banks failing, banks really had to jack up their deposit pricing, so that affected their net interest margins and top line. And now we're in a sort of a steady state where things are starting to benefit marginally, and that's really helped the top line.
How much did the outperformances come from interest rates going lower versus an actual improvement or ongoing strength in the underlying loans that they've made?
Yeah, so the rate cuts really happened in September, so not really affecting the third quarter reported numbers, but that'll be more of a fourth quarter effect. In the third quarter, it's really, they've got these loans and assets that were put on their books 3, 4, 5 years ago at a much lower rate. So those reprice at a higher rate now, and that's really helping the top line.
The reason why I ask is because there's a sort of forward look that we're trying to glean from some of the earnings that we've seen in terms of the credit impulse to the rest of the economy, and whether it's the Ally Financials of the world and the warning about credit deterioration that really will be the dominant theme going forward, or whether it's going to be the ongoing concern around just income based on rates. Do you think that based on the earnings that we've gotten so far, that the fears of consumer credit deteriorating rapidly are overblown and that we're not seeing anything in these earnings that really confirm that?
On credit quality, things the banks are really stacking another quarter of strong credit performance, and there hasn't really been anything that would concern us in terms of deterioration of the overall economy. Banks, you can view them as a read-through across for the overall economic backdrop. And what the banks are saying on the regional standpoint is credit's been really benign. We're seeing really stable net charge-offs. They're starting to inch up a little bit, but really nothing to be worried about or overly concerned about.
We haven't spoken to you for a while, but you were coming on loads, and we talk about commercial real estate every single time. What happened to the story?
Yeah, it's a long-term picture, right? So we get these negative headlines, and PNC is one that has talked about being in very early innings of the unraveling of office commercial real estate. So it's going to be something that we'll continue to talk about over the course of next year and the year after. But again, the banks have added to the reserves on these office commercial real estate properties, and now we're talking about north of 10% reserves on these problematic loans. So any sort of deterioration is going to be absorbed by those.
You're fairly confident we can handle this into 25, even if rates don't come down as much as people think they will?
Yeah, at this point, I think so, because these are known risks that the banks continue to add to reserves, and it's not going to surprise anybody if there's going to be an office default coming down the road.
We've seen a few of them. Herman, it's good to see you.
Thank you.
Thank you very much. On the regional banks, the coast is clear if you listen to the major players. The big focus is on the regionals for the next few months.
Yeah, I love how you try to bring up, okay, is there any boogeyman? What about commercial real estate? We were using that for a while, and that's not there either. I think we should take it a step further. At what point are we talking about some of these banks creating credit going forward, actually creating a line of credit to lower income individuals who have been kind of priced out? And that, I think, is a sort of interesting follow-on to this.
Yeah, when we're talking about credit, particularly for the large lenders, we're talking about prime consumers. We're not talking about low-income consumers at all. So when we say things like the coast is clear, it's for the prime consumers with credit scores above 800, which is ridiculous.
Right. Well, and they push back on that. But these regional banks, are they expanding credit? That's what I want to know.
Okay. Up next on the program, David Leibovitz of JPMorgan, Jeremy Stretch of CIBC, Dana Peterson of the Conference Board, Brian Weinstein of Morgan Stanley. In the next hour, an ECB rate decision, a news conference, and a lot of data. Jobless claims and retail sales just around the corner.
Technicals are fiercely strong.
The amount of liquidity in the markets is phenomenal.
I still think you're going to get the best juice from the equity market.
You're seeing it, stocks and bonds are trading uncorrelated.
It probably is far more uncertain for bond investors than it is for equity investors.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now with equity futures on the S&P up 0.4 and NASDAQ up 0.8. Some outperformance thanks to TSMC overnight. We'll get to that a little bit later. We need to talk about the next hour on this program. In 15 minutes' time, a rate decision from the ECB. 15 minutes after that, jobless claims and retail sales. And then 15 minutes later, an ECB news conference with Christine Lagarde. This hour, stacked.
Yeah, really what I'm looking for is two things, actually. One of them is the divergence, the ongoing divergence between the ECB and the Fed. To Mohamed El-Erian's point, how much do we see the ECB on a much faster path of rate cutting than the Federal Reserve? And second of all, how much is this market baking in consumer strength at this point? Has the pendulum swung to this assumption that the U.S. is in some sort of strong position? And is that what the data is going to confirm?
Fascinating conversation with Mohamed El-Erian, because you wake up, you see also the revisions on inflation that obviously the ECB cares about revised down. But then Mohamed brought up a really good point. The dispersion around Europe, when even it becomes something like inflation, which is for the single mandated ECB matters, 4.3% in Belgium, 3.3% in the Netherlands, 1.7% in Spain, and Ireland, 0%. How much harder is Christine Lagarde's job than it is, say, Jay Powell?
The last meeting was only about 5 weeks ago at the ECB. Since then, downside surprise on inflation, ugly PMIs. I went through these notes earlier, worth repeating. Deutsche Bank, the European picture has weakened considerably. Goldman Sachs, since that September meeting, the Eurozone data have been significantly weaker. And JPMorgan, this line from JPMorgan, Lisa teased this out of the conversation with Mohamed El-Erian as well. On the outlook for inflation, there is a strong case for delivering cuts a bit more quickly to help avoid a more abrupt growth slowdown and, hence, a disorderly disinflationary process. Mohamed made a similar point to you.
So what's the consequence for the ECB? Do we end up talking about going back to zero? How much can they cut? How far can they cut? How aggressively will they? And will this be a forward-looking ECB at a time where forward guidance from them has been worth not very much? I mean, basically, what have they basically been able to telegraph in some of these press conferences in the past 6 to 12 months?
That rate decision, 8:15 Eastern Time. Coming up this hour, we'll catch up with David Leibovitz of JPMorgan as traders drive another small cap rotation. It's Jeremy Stretch of CIBC reacting to the ECB rate decision just around the corner, and Dana Peterson of the Conference Board on mixed consumer signals. We begin this hour with stocks inching higher as investors await retail sales and another round of jobless claims dropping in just under 30 minutes' time. David Leibovitz of JPMorgan Asset Management saying, together with signs that the labour market momentum is softening, it seems unlikely the recent data has changed the Fed's resolve around policy normalisation, and we expect the Fed will likely deliver 2 additional 25 basis point rate cuts through to year end. David joins us now for more. David, good morning.
Morning. How are you?
We are about 27 minutes away from jobless claims and retail sales. What are you expecting?
So I think that the claims number is going to be a little bit messy, for lack of a better term. I mean, there's been a lot going on in the labor market between strikes and natural disasters and so on and so forth. And so I think you'll see the number come in slightly from where it was last week, but we're definitely not going to go back down to the low 220s where we had been over the prior couple of weeks. I think the bigger question here, given the noise that we expect in the claims data, is what we see from retail sales. Because our big story this year has been that labor income looks okay. And in the United States, when consumers have income, they turn around and they spend it. And so if we're seeing that kind of re-strengthening in the labor market that was observed in the most recent payrolls report, coupled with a better retail sales report, that's going to give us conviction about the near-term runway for the U.S. economy.
We had this conversation with Mohamed earlier this morning about data dependence. How dependable is this data? You talked about the hurricane distortions that we're seeing in some of the jobs data. Wouldn't we expect something similar in retail sales?
Well, I think that the issue with the labor market data is really going to be one that, yes, the noise is coming through from the natural disasters and the strikes, and those are more regional issues, right? The retail sales stuff is going to give us a more holistic picture and not necessarily have those same distortions. What I would say, on the other hand, though, with respect to the labor market data is that response rates have been coming down quite significantly. And so overall, when we look at the labor market, we're very much of the view of let's not extrapolate one single data point into a broader trend. Let's try to look at the mosaic here and see what that broader data set is telling us about the health of the labor market, which is going to dictate the path for the economy going forward.
Talking about the mosaic, it sounds like you see retail sales as a more important part of that mosaic today, given the fact that it would be confirmation of the trend that we're hearing about in a lot of the earnings.
I think it will. And it's not only about the retail sales story, but I also think it's going to be about the industrial production story that we see this morning. Yes, retail sales will give us a good read on where consumers are spending, how much they're spending, what does that breakdown look like between goods and services, which is still very central to our thesis on the U.S. economy. But one of the things that we're also expecting as the Fed continues to ease policy here is that goods and manufacturing are going to begin to come back. Now, you may not necessarily see that show up in the industrial production report today, but I think that the manufacturing side of the economy is going to be increasingly important going forward, because if consumers do begin to soften here on the back of maybe a cooler labor market, we do think that there could be room for manufacturing to pick up that slack.
We're talking about the U.S. and we're about 9 minutes away from an ECB rate decision. And I just keep thinking about the dollar this morning and how much there could be a potential 1-2 punch for the euro that leads to dollar strength. We're talking about potential strength in the U.S. consumer, edified by retail sales. At the same time, the ECB is grappling with a much different picture. How much is that basically the thesis at a time when that divergence seems to be, I don't want to say a certainty, but a growing base case?
It is really difficult to get excited about Europe these days for a number of reasons. I thought you summed it up well. The PMIs, you look at the unemployment rate, it's 2 percentage points higher than it is in the United States. It's just very difficult to get excited about what's going on there. And so when we think about the currency side of all of that, we'll leave the equities be for the time being. We even struggle to see how the euro can do anything, spectacular here going forward. If you think about what drives currency in the short run, it's all about rate differentials and growth differentials. And what we're seeing now is a U.S. economy with more resilience and a European economy that is continuing to crumble, coupled with a Fed that probably isn't going to be able to move as far as what people were pricing in a couple of weeks back.
You talked about the fact that Americans get money in their pockets, they immediately go out and spend it. How wide is the gap between the American consumer and the European consumer?
I think it's behavioral. When the income runs out, the credit cards come out here in the United States, and consumers are very willing to take on leverage in a way that simply isn't the case in a lot of other places in the world, particularly in Europe. You even think about the way that European investors behave, right? They have a much greater preference for dividends and income than they do for capital appreciation. And so that more conservative approach, again, I think puts a lid on how much the European economy can grow. But hopefully these rate cuts are able to get something going.
The government sets the tone for all of this as well. We started the program this way this morning, talking about what often comes out of Europe. It's things like regulation around the auto manufacturers. It's things like fines for the tech players. That's problematic. Go create the companies. This was ultimately the Draghi push of the last month or so. Go create the companies that can compete with these American giants.
Yeah, it's the plus and the minus of hope that comes with leverage versus sort of a fatalism or reality check that comes with fiscal prudence. And there needs to be a balance. And right now it does seem like the hope of just re-leveraging and taking out the credit card and keeping on going is actually keeping the U.S. economy doing pretty well. And maybe Europe should take a little bit of a page from that.
Well, I also think we just have such a dynamic economy here in the United States. I mean, one of the things that we've seen since the pandemic is that, small business creation has gone through the roof. You can create new businesses here in a way that isn't necessarily the case in a lot of other places. And so you have that dynamism embedded in the economy that I think allows us to stay on the front foot and move forward during periods of time where other economies may be struggling.
That word hope, people became more hopeful about Europe because of what China was about to do.
Right.
What's your assessment of what China's done so far?
I still think that China is putting Band-Aids on a problem that requires surgery. We know what the underlying issues are. There's too much debt, there's a property issue, and underpinning all of that are pretty unattractive demographics. And so the bazooka needs to be fired, but it needs to be fired on the fiscal side, not just on the monetary side. And we were having this conversation the other day when the information began to come out of the PBOC and other monetary authorities. You have to differentiate between flow and fundamentals. And liquidity, the provision of liquidity, that flow will lift markets temporarily, but if the fundamentals don't show up, the durability of that rally is very much going to be called into question. I think that's what you're seeing right now, and I think that's why we need to see the fiscal cannon fired in order for this rally to have legs going forward.
So buy U.S. stocks, hold a little bit of cash, call it a day?
U.S. equities, we still like Japanese equities as well. I think the combination of the corporate governance story and the better nominal growth story is a pretty powerful one. But we do prefer markets where that underlying economic growth story is more robust. And so the U.S., Japan, we're not abandoning EM and China. We're still playing there because we do think that there could be an opportunity. And furthermore, when you look at the way the Chinese market behaves, it usually goes up by the elevator and down by the escalator. And so we think we'll have a little bit of time to get out of the way of the bus if things there aren't working. I would say that the least interesting part of our portfolios is probably on the fixed income side. We continue to really like high yield bonds. We really like credit broadly, and we're neutral on duration. You look at the moves that we continue to see in the Treasury market, and it's just very difficult to get off the fence when volatility is this high. I think the question on duration going forward is more about the price at which you add duration, whether or not, as opposed to whether or not you add duration at all.
So well said, because the Chinese market went up 100 floors just like that.
Right.
The space for wheat. David, it's good to see you. Thank you,
see
sir. David Leibovitz there of JPMorgan Asset Management. Equities right now on the S&P 500, just about positive by a couple of tenths of 1% on the S&P, up by 0.4. The euro, 108.65, totally unchanged going into this ECB rate decision just a few minutes away. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. A new national poll of likely voters gives Donald Trump a narrow lead over Kamala Harris. The Fox News survey from early October has the Republican at 50% versus 48% for the Democrat, which is within the 3% margin of error. Separate Quinnipiac polling in swing states gives Trump a 7-point lead in Georgia and Harris a 2-point advantage in North Carolina. U.S. B-2 stealth bombers have struck weapons storage sites linked to Houthi rebels in Yemen. It's the latest effort to blunt attacks by the Iran-backed militant group that have roiled commercial shipping in the Red Sea. Defense Secretary Lloyd Austin says that the use of B-2 bombers was intended to send a message. Despite numerous strikes by Israel and the U.S. on the Houthis, the allies have so far been unable to halt its attacks. Visitors of Disney's theme parks have a new way to skip the long lines at its biggest attractions. The company is launching the Lightning Lane Premier Pass starting next week, which guests can use once per ride for an entire day. The pass, though, will cost $400 a person. Disney says very limited quantities of the pass will be available at first, and the company may adjust its pricing and availability next year based on date and demand. That's your Bloomberg Brief. John.
Danny, thank you. In a word, no. Up next, just no chance. Up next on the program, the ECB rate decision just around the corner, live from New York City this morning. Good morning to you all. Equity futures positive by 0.4. The euro unchanged at 108.63. Lisa, the only person in TV worldwide who gets mid-show dry cleaning.
I spilled coffee.
Is that what happened?
Come on, the jacket goes on.
And they got that
ECB
dry cleaned in
decision.
like 2 hours.
Come on, we're
Only.
5 seconds away.
Only in New York City, seconds away from an ECB rate decision. They're in Slovenia this time, the ECB on tour. Often happens. Wait in a few seconds for this ECB rate decision. I'll share with you the last interest rate decision. That was 350 with a rate cut. This is what we get right now from the ECB, cutting the deposit rate to 325 from 350, largely in line with expectations from the European Central Bank. So it's a 25 basis point reduction from the ECB. They say they'll keep rates sufficiently restricted for as long as needed, which sounds quite bizarre when you're cutting interest rates, but ultimately this is as inflation comes down and it's now below target on a headline rate. So that's your rate cut reduction. It comes from the ECB. We were looking for 325 and that's exactly what we got. The euro looks like this at 108.73, firmer by around about 1/10%. So a slightly stronger euro in the mix here, Lisa.
Yeah, not pre-committing to a particular rate path and talking about going forward meeting by meeting. Still, right now, this is basically as expected, cutting 25 basis points, not giving any forward guidance, which why should they, given the fact that they haven't been able to provide much going forward. Disinflationary process is well on track, they say, which really, I think, is the key question. How much are you looking for this to be a disinflation and deflation story versus inflation? However, this is interesting. Inflation is expected to rise in the coming months, this according to the ECB. So kind of a mixed message right now.
I'll go through the fuller statement for you. So inflation expected to rise in the coming months before declining to target in the course of the next year. And that's the more important piece of this for the ECB in terms of how they set policy. Domestic inflation remains high as wages are still rising at an elevated pace. At the same time, labour cost pressures are set to continue easing gradually, with profits partially buffering their impact on inflation. They go on to say the Governing Council is determined to ensure that inflation returns to its 2% medium-term target in a timely manner. It will keep policy rates sufficiently restrictive for as long as necessary to achieve this aim. The Governing Council will continue to follow a data-dependent and meeting-by-meeting approach to determining the appropriate level and duration of restriction. In particular, its interest rate decisions will be based on its assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary monetary policy transmission, the Governing Council is not pre-committing to a particular rate path. Over in Slovenia, Lizzie Burden joins us now for more. Lizzie, what do you make of this one?
Well, as you say, it was all but certain. Every single one of the 65 economists we surveyed saw this coming. It's the third cut of the easing cycle. Notably, it's the first back-to-back rate cut we've seen from the ECB in over a decade, John. But it's been such a turnaround since September when, remember, Christine Lagarde was really pointing to December for the next cut. And it's because you've got inflation back below the 2% target and all the signs suggesting weakness in growth when you look at the survey data. Now, if you put this decision aside, the press conference in just under half an hour is really going to be all about the path ahead. And as you say, looking at that guidance, not a whole lot of clues being given. Rate bets are steady off the back of this decision. Again, they reiterate that they need to keep policy sufficiently restrictive for as long as needed to keep inflation at 2% in the medium term. That is important because, yes, they're back under that 2% level now, but as you say, they're expecting inflation to go back up again towards the end of the year. So that is similar to the situation in the UK. Don't hold your breath for more forward guidance at this press conference. You've already had the Slovenian central bank governor, the host of this conference today, saying that a cut today doesn't automatically mean they'll go again in December. If she sounds like that, Christine Lagarde, it's going to be a volatility killer.
Lizzie, I'm just struck by how different this statement is from what we hear by the Fed, where they say we do not welcome any further weakening in the labor market. This ECB statement talks about labor cost pressures continuing to ease gradually, but still a big part of the inflation. Domestic inflation is high and wages are rising at an elevated pace. Lizzie, how much does that cohere with data that suggests a real deceleration in activity across the Euro region?
Well, look, the big question mark in terms of the data, Lisa, is the labour market when it comes to the euro area. Think about how you've got, yes, signs of easing and big companies like BASF and ThyssenKrupp offloading workers. Volkswagen notably thinking about closing plants in Germany for the first time. But at the same time, unemployment still at a record low. You've got that pressure on wages upwards, keeping inflation going, a healthy clip of wage growth. So really a difficult situation. That's what they want certainty on, the labour market. And by December, they'll have more data on negotiated wages.
Lizzie, appreciate the update from you. Enjoy Slovenia and the news conference that's about to take place in about 25 minutes' time. So the ECB reducing interest rates by 25 basis points as expected by pretty much everybody. The assessment on inflation, the disinflationary process is well on track. And the approach, it's very different to the approach that we see taking place at the Federal Reserve. They're talking about recalibration, which potentially explains the next 100, 150 basis points, maybe even more, of interest rate reductions. This ECB is still treating every meeting as a live meeting, not pre-committing to anything and saying we'll take this meeting by meeting. And that was the approach of the September meeting from the ECB. And then the data happened. Reality hit them in the face. The PMIs were dreadful. We had a downside surprise on Eurozone inflation, and here we are, an interest rate reduction.
So there are two questions here. Is this the consequence of the ECB not being a dual mandate central bank? The consequence of them only going after inflation and still seeing what they call as elevated wage inflation? Or is this an issue where the ECB actually has more of an inflation problem that is intractable, right? I mean, are they basically seeing that as an issue? Or is this a matter of them just having a different mandate than the Federal Reserve?
Let's get across to Jeremy Stretch of CIBC. Jeremy, your initial take on this, and then I want to get into ultimately what is holding them back from pre-committing to even more, given how dreadful the backdrop is for European growth.
Well, clearly the data backdrop has materially deteriorated since that September meeting. I think you've touched on the PMIs. I think the inflation downturn was obviously more aggressive than expected. Although if you listen to the September press briefing, Madame Lagarde tried to pre-prepare the market for a downturn in September due to base effects. But I think it is still this sort of broader negative backdrop in terms of the global manufacturing sector, which really is amplifying the Eurozone downturn, which is warranting easier policy. But the problem from an ECB perspective is the nature of the composition of the council, where you do have a whole range of policy members with very different perspectives. And you still have those very hawkish, biased members from the core members of the European Union, such as Germany and Austria, who are reluctant to sanction a very aggressive easing profile. So that leaves Madame Lagarde with a very difficult balancing act. And so she continues to try and pursue that by this meeting-by-meeting, data-dependent approach. But I think it is still very much the case that we're now moving towards a more sequential policy backdrop. So I suspect that it's going to be a case of the ECB maintaining a data-dependent meeting-by-meeting approach, but I think we're probably going to be heading headlong towards the deposit rate heading towards 2% by the middle of next year.
There's a big wrinkle in that approach, though, Jeremy, and you know it. When Draghi led the ECB, he had to convince the Germans to do things they did not want to do. This time around, though, the German economy is the weak link. And if I'm looking at the euro this morning, here's my question to you in foreign exchange. Should the euro be trading on rate differentials or growth differentials backed up by an ECB that's willing to support growth in a material way?
Well, I think at the moment we're looking at rate differentials. I think we've seen a clear crossover in terms of what's been priced for immediate policy action from the Fed relative to the ECB over the course of the last month. That's really been constituent with this retreat in terms of euro-dollar over the course of the last 2 to 3 weeks. And if we are still going to see the ECB being very much biased, or the market interpretation of the ECB being biased towards policy easing, then that does imply that the euro is going to continue to struggle somewhat. But I think we've got to a situation now where a lot of the real money euro longs, I think, have probably been cleared away. We're looking at a market which is now increasingly looking a little bit oversold. So I think it is the case that headwinds for the euro are obvious. The risk of further activity from the ECB is evidential. But I think it may be the case that as we get nearer that sort of 108 threshold, that might be an opportunity to expect some degree of slowdown in terms of this retreat from those recent heady highs of 112.
Jeremy, how much does the ECB essentially have their hands tied as a result of the pace of the Fed? How much do they want to keep the euro in this sort of zone in order to prevent import inflation from really coming into play?
Well, absolutely. The valuation of the euro obviously has an impact via the import price dynamic. So in a sense, you have nominal commodity prices, which will always be evidential for the inflation backdrop. But the euro does amplify that if we were to see a substantial cheapening of the euro. So in a sense, there is a recognition as to what the Fed is doing is relevant for the ECB. But I think the majority of the ECB members will try and look at the policy narrative in isolation, look at that single mandate, as you've touched upon. I think that is very notable, that single mandate of maintaining inflation, and that is how they will pursue policy. But if the euro were to cheapen back to 104, 105, that's not our base case, but if that were to happen, then obviously that would create greater inflationary pressures, and that would prove to be problematic for the ECB policy narrative.
Jeremy, appreciate the update, sir, and your reaction to an ECB rate reduction this morning. Jeremy Stretch there of CIBC, a 25 basis point cut from the ECB. That news conference with President Lagarde is about 20 minutes away. We'll have plenty of questions for her, no doubt. If you're not satisfied with the answers, we've got a follow-up for you. Next Tuesday, don't miss this, Bloomberg's Francine Lacqua sitting down for an exclusive conversation with the ECB President, Christine Lagarde. That will be must-watch television next Tuesday. Must-watch TV in about 20 minutes' time. You've cut interest rates. Why aren't you cutting interest rates again at the ECB?
Yeah, and why aren't you more confident in the disinflation process if you see that kind of weakness coming down the pike economically?
Are we Fed independent? Are we election independent? Are we China independent? No, no, no.
Well, on Friday afternoon, we'll be independent of this discussion until we start on Monday. That's all I can say.
Up next on this program, retail sales and jobless claims in America reacting. Dana Peterson of the Conference Board, Brian Weinstein of Morgan Stanley. From New York, this is Bloomberg. "15 minutes ago, the ECB reduced interest rates by 25 basis points. The next stop for the Federal Reserve is November 7th, with a lot of data in between. Some of that data is set to be distorted by the hurricanes and some of the strikes we've seen across this country. We're waiting for some of that data right now. Retail sales and jobless claims just seconds away. Equity futures on the S&P 500 going into it, shaping up as follows. Your scores look like this: up 0.4% on the S&P 500, on the Nasdaq 100 higher by 0.8%. And here's the data right now. It's an upside surprise on US retail sales. We were looking for 0.3 month over month. We got 0.4. And if you look at the control group, which goes into GDP, we got 0.7. That is stronger than expected. On jobless claims, 259 was the estimate, 241 is the number. We can spend some time on potential distortions. I think for a lot of people in this market, they'll put a bit more weight on that upside surprise from US retail sales. You see the Nasdaq up by 0.9%, the S&P 500 up 0.5%. If you switch up the board and get to the bond market, we can get a feel for how treasuries are reacting to this. As I said, we're focused on retail sales. We're moving lower on treasuries and up in yield, up by 6 basis points on a 2-year, back through 4% on a 10-year, up by 6 to 4.07. The data out just moments ago, an upside surprise.
And to me, what this basically is confirmation that the U.S. consumer is still out there and spending. You mentioned the control group, the fact that it was 0.7. If you strip out auto and gas, that is what we're looking at in terms of the pop in retail sales. The expectation had been 0.3%. When you take a look, even stripping out autos, up 0.5% versus 0.1%. Key question here. Are we basically still in Goldilocks? Does this confirm Goldilocks, or does this confirm something else, right? I mean, it's basically taking off the risk case scenario of recession once again and confirming some of the bullish feel.
Let's ask Dana Peterson at the conference board. She joins us now for more. Dana, welcome to the programme. Early days, just the last few seconds this data's dropped, so you've only had a few minutes. Just tell us your first reaction to it. What do you think of retail sales?
I think retail sales are strong, both in nominal terms and also in real terms. If you account for inflation, you're probably looking at an increase of roughly 0.2. And if you put that together for the quarter, we're looking at anywhere from 3.5 to 3.75% annualized growth in retail sales in the third quarter, which bodes very well for consumption. So consumers have the income, they're working. Yes, they're complaining about the level of prices, but they're certainly seeing prices fall for those big durable goods like furniture and cars, and they're running out there and they're buying.
It's sending treasuries lower and yields higher. Jobless claims pulled back, but Dana, I really don't know what to do with jobless claims. We gapped out last week to the highest print of the year. A lot of people suggested there was a hurricane distortion in that economic data. How much weight do you put on the labour market data of the last few weeks? And for that matter, how much weight would you put on the data for the next 2 months?
Sure, I've been saying that the labor market in the United States is fine, and certainly we did see an uptick in jobless claims over the last couple of weeks. But fortunately, we do have state data, and if you look at the states that were impacted by the hurricanes, you did see a pickup in jobless claims. In fact, I took Florida, Tennessee, North Carolina, and South Carolina, and they represented roughly 36% of the increase in jobless claims that we saw 2 weeks ago. And indeed, the other big portion was out of Michigan. I don't know what happened in Michigan that week, but jobless claims were low just about everywhere else in the United States. And that's probably what we're going to continue to see once you strip out those hurricane effects.
Dana, if we're seeing basically no real pickup, if you strip out those effects in jobless claims, and we're seeing ongoing retail strength, particularly when it comes to back to school spending, why are people not feeling it?
Well, I think people are not feeling it because there's a lot of anxiety out there. Even though most people are working, they're still concerned about the fact that they're not seeing as many job openings. But I think job openings are falling because companies have been hiring and they've been replenishing their payrolls. And indeed, when we ask CEOs of the largest firms, they continue to say that they are either going to hire more people or hoard workers. Very few, only just above 20% are saying they're going to let people go. So that's 80% who are not going to touch their labor force. So as long as people are working, they're still going out there and spending, even though they're saying, well, I'm worried about elections, I'm worried about taxes, I'm worried about the fact that I might lose my job. But nonetheless, they continue to hold on to their jobs and they're running out there and they're spending.
We just got an ECB rate decision, and we got from some of the statements were that they're still concerned about inflation. Part of that is just simply because that is their mandate. Here in the U.S., inflation doesn't seem to be at the forefront of a lot of central bankers' minds. It seems like inflation is believed to be well under control. At what point is this strength that we're seeing in the consumer inflationary, or have we basically written that off?
Well, I think the thing is consumers have been spending pretty consistently over the last 2 years, and we saw upward revisions in inflation, and certainly we saw big upward revisions in income. But I think the inflation that we're seeing, most of it is from housing, shelter costs. Again, shelter costs are slowing, but it's taking time. It's going to continue to take time. We probably won't see further material slowing in shelter costs until probably the middle of next year, where we actually see it reach a bottom. And then there's also elevated wage gains, and wages are still rising at a pretty healthy clip. That's feeding into inflation. And then you also have these other structural changes, an aging demographic that are raising costs for healthcare and health insurance, and technology, which is raising the cost of cars, and all these natural disasters. We just had 2 major hurricanes that are affecting insurance for homes. So you have these things that the Fed can't necessarily manage. Certainly the housing area, yes, and we're seeing that slowly ease. But for the most part, I don't really see consumer activity as being terribly inflationary. It's really those outside forces on the consumer that are forcing them to have to pay more.
When you look at this retail sales data, though, and kind of a blowout in some of these categories, do you think it's going to have any implication on the Fed's decision on November 7th, given the fact that they are data dependent?
Absolutely. So I think all the data we've seen, from the labor market to the stickiness in core inflation, both in the PCE and the core deflator, and then also the continued spending by consumers, the Fed can probably say, well, we don't need to go 50 basis points. We're probably fine with 25 basis points. We still want to be very cautious here and make sure that inflation continues to trend back to the 2% target, not just overall inflation, which is the target that they're looking, which is what they target, but they're also looking at underlying inflation, and they don't really want to see stickiness or an upturn in that. So I think the Fed needs to continue to move cautiously, and a 25 basis point rate cut makes the most sense at this point, in our view.
Dana, appreciate the update. As always, Dana Peterson there at the conference board. The data this morning, better than expected, both on retail sales and on jobless claims. With us around the table, Brian Weinstein of Morgan Stanley. Brian, it's good to see you.
You too.
This is kind of moving your way. You said the biggest risk is higher rates.
Yeah.
How much higher?
Listen, I don't think a lot higher anytime soon. I think we're kind of stuck in a range, right? I mean, we just said it. It's amazing the Fed's going to ease 25 after this data. That's why the 50. That's why the 50 was so brilliant, right? If they went 25 last time, they couldn't go now. But now that they've calibrated to that big shock, and now we're recalibrating. We can do 25 because it's a long-term trend. I don't think the data dependency story is real. I know Mohamed El-Erian's on this. He's right. It's they're on a little bit of a path. They want to ease, and eventually you'll have much steeper curves and much higher long-term rates. But I think for now, with all the election stuff and the hurricane distortions, bit of a range. Fixed income's had a great year. It's giving you your coupon a little bit more, and I think that trend can continue just for a little while.
Is that what recalibration is? Is that McKinsey for autopilot?
Yeah, I think so. I think it's autopilot. Again, 5.5, everyone would agree. Surprised we got there. Didn't kill the economy. We should keep that in mind. But it's higher than neutral. I think we can all agree on that. We don't know where it is. We know it's lower. Inflation's fallen a lot, and so you ease a little bit where you can, and you don't fall behind the curve. There's a risk to it, but the risks will be apparent next year. We'll see how smart it is. When we look back on it, it looks really smart now.
Hold on a second. We have to develop that, because this is basically the question that we've been asking. At what point is this raising the risk of inflation later on? You're saying that potentially that's a 2025 story. Is that correct?
That's right. Listen, I think it does raise the risk of inflation later on. And I think what the interesting thing about inflation is that it's a very long, if you look at long-term charts of inflation, there's these long-term trends. So for a long time, most of our careers, we were kind of hanging out in that sub 2%. The trend was down, almost, are we Japan? Is this going to be disinflation forever? We've broken that. And I think when the Fed eases and gets ahead of the curve, what we're going to see is inflation stays stickier above 2%. I would call inflation in a 2 to 4% range. The market disagrees, right? Break-evens are in the low 2s, so we're not priced for that. But I do think next year we'll see that inflation is going to be a bit above 2, maybe a bit uncomfortably above 2. But I don't think the Fed will be able to react to it aggressively. It's going to make their life more difficult later. But they have a dual mandate, so they can play the game versus, say, the ECB.
Right, which is the reason why people are encouraged to buy U.S. stocks, because this is a central bank in the U.S. that wants to support economic growth and the ongoing strength in the U.S. economy. How much do you just follow the Fed? Don't fight the Fed, and this is the ultimate Fed put.
Listen, for now, I don't think you want to fight the Fed. If there was growth other places that was really strong, I mean, listen, you could pick out some emerging markets and we'll see what China does. But say versus Europe, yes, I think you want to own the U.S. You have the tech story. You have a central bank that's being, it's getting easier. You're running a 6% fiscal deficit. You have two candidates that are going to spend more money. Again, there's a cost to all this. It's not free forever, but it certainly seems cheap enough now. Unless we get that big shock in rates, which I think is a later story.
Who pays the price? You said there's a cost. Who pays the price? Europe, China?
Well,
the United States?
I think eventually the United States, right? Eventually inflation does go up. I think eventually rates do go up. Borrowing costs have already gone up. So you're seeing this happens in phases, right? People were shocked when borrowing costs went from 1 to 4 and 5.
Yep.
Corporate markets performing pretty well, right? We talked about maybe credit trading through treasuries eventually. Again, it's a long-term story, but you're seeing credit at tights. Why? Because credit is a better risk reward than treasuries. So there are costs. They just don't appear the moment that we speak about them. It's a 26 story, and it depends on what the rest of the world does and what the political situation is.
You can't finish an interview with a zinger like that. That is just absolutely... You're coming back. We're going to do a whole conversation on what you just said at the end there.
All right.
Brian, thank you, sir. Brian Weinstein of Morgan Stanley. Amazing, amazing. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Meta has laid off a number of employees as part of a larger team restructuring initiative. Employees in departments including WhatsApp, Instagram, and Reality Labs were among those affected. Meta didn't specify how many jobs were cut or which teams were affected, but did note that some employees were being moved to different jobs. Uber may be considering a bid for Expedia. According to the FT, Uber approached its advisors in recent months about a possible acquisition of the online travel company. The ride-hailing giant has not officially reached out to Expedia, and the FT says that there are no ongoing talks between the companies. Uber CEO Dara Khosrowshahi was CEO of Expedia from 2005 to 2017 and does remain a board member. Former boxer Floyd Mayweather is buying $402 million of affordable housing in New York City. According to a person familiar with the matter, many of the more than 60 buildings are located in Upper Manhattan. Mayweather has jumped into real estate before, investing in a hospitality fund run by CGI Merchant Group. And that's your brief, John.
Danny, thank you. Thanks for that. Up next on the programme, an ECB news conference with President Lagarde. The opening bow 45 minutes away. In just a moment, an ECB news conference begins in Slovenia. This time, the ECB is on tour after cutting interest rates by 25 basis points. Let's get you the calendar, the trading diary for the next couple of days, and a sneak peek of next week. This afternoon, Netflix earnings are coming tomorrow. Housing starts and building permits. We get some Fed speak from Kashkari, Waller and Bostic. Looking ahead to next week. Next Tuesday, GM earnings. Wednesday, more results from Tesla. Thursday, another round of jobless claims, plus PMI data and more earnings from UPS and American Airlines. As the photographers snap away at President Lagarde following that interest rate reduction of 25 basis points, this just drops from Deutsche Bank. It's an important line. Chances are that today's decision represents a pivot point into a faster normalization of monetary policy after back-to-back rate cuts, Lisa, from the ECB.
So basically, this is the market expecting, or certainly Deutsche Bank expecting, an ECB that recognizes the weakness a little bit and sort of telegraphs that they are going to continue adjusting policy. This is the question about whether or not they are going to prioritize some of the weakness, and that is what I'm going to be listening to when we listen and hear from Christine Lagarde.
That's what ING as well is focused on, saying the ECB looks much more concerned about the lack of growth and inflation undershooting than 5 weeks ago, and it's hard to see how today's rate cut cannot be seen as a signal that they're in a hurry to potentially bring those interest rates down further.
I just wonder how spooked they were by the PMIs in the last few weeks, because the PMIs were pretty dreadful. Pretty bad, speaking to a bad outlook for European growth, and much worse compared to what we're seeing in the States. We've just had retail sales drop in America, coming in much better than anticipated, and we're still talking about the Federal Reserve reducing interest rates on November 7th.
So this is what I find fascinating, is that everybody's take on this is exactly not what they said. And so the ECB came out and they talked about the potential for inflation to remain sticky or even reaccelerate before going back to 2%. And yet people listen to this and they say, fine, but you've just cut twice back to back and probably going to keep cutting, and you're going to recognize the weakness more than you're going to put it in your statement.
That news conference dated pretty quickly last time around in mid-September from this ECB. Some of the commentary since then, the European picture has weakened considerably in recent weeks. That was Deutsche Bank. This was a line from JPMorgan, and I would love it if someone in this news conference asked this question. There is a strong case for delivering cuts a bit more quickly to help avoid a more abrupt growth slowdown and hence a disorderly disinflation process.
How much is this ECB going to be fighting disinflation or outright deflation once again if they see the same level of weakness that we certainly saw in those PMIs.
And let's face it, given the risks on the horizon, things could get worse, not better, based on what may or may not happen in the election that takes place in this country over the next few weeks.
The walls are going up in China, and the walls are going up in the United States.
Let's head over to Slovenia and listen in to the news conference with Christine Lagarde, the ECB president, following that 25 basis point reduction.
Staff of the Central Bank of Slovenia and to all the Slovenian authorities and the Slovenian people. We've been beautifully greeted, and it's a real pleasure to have spent the last 2 days here in your company and in Ljubljana. With that, good afternoon to all of you. The Vice President and I welcome you to our press conference. Again, thank you, Boštjan, Governor Valle, for your kind of hospitality, and thank you for your welcome, and we express all our gratitude to your staff, some of whom are present in this room, actually. The Governing Council today decided to lower the 3 key ECB interest rates by 25 basis points. In particular, the decision to lower the deposit facility rate, the rate through which we steer the monetary policy stance, is based on our updated state assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission. The incoming information on inflation shows that the disinflationary process is well on track. The inflation outlook is also affected by recent downside surprises in indicators of economic activity. Meanwhile, financing conditions remain restrictive. Inflation is expected to rise in the coming months before declining to target in the course of next year. Domestic inflation remains high as wages are still rising at an elevated pace. At the same time, labor cost pressures are set to continue easing gradually, with profit partially buffering their impact on inflation. We are determined to ensure that inflation returns to our 2% medium-term target in a timely manner. We will keep policy rates sufficiently restrictive for as long as necessary to achieve this aim. We will continue to follow a data-dependent and meeting-by-meeting approach to determining the appropriate level and duration of restriction. In particular, our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. The decisions taken today are set out in a press release available on our website. And I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. Looking at the economic activity, the incoming information suggests that economic activity has been somewhat weaker than expected. While industrial production has been particularly volatile over the summer months, surveys indicate that manufacturing has continued to contract. For services, surveys show an uptick in August, likely supported by a strong summer tourism season, but the latest data point to more sluggish growth. Businesses are expanding their investment only slowly, while housing investment continues to fall. Exports have weakened, especially for goods. Although incomes rose in the second quarter, households consumed less, contrary to expectations. The saving rate stood at 15.7% in the second quarter, well above the pre-pandemic average of 12.9%. At the same time, recent survey evidence points to a gradual recovery in household spending. The labor market remains resilient. The unemployment rate stayed at its historical low of 6.4% in August. However, surveys point to slowing employment growth and a further moderation in the demand for labor. We expect the economy to strengthen over time as rising real incomes allow households to consume more. The gradually fading effects of restrictive monetary policy should support consumption and investment. Exports should contribute to the recovery as global demand rises. Fiscal and structural policies should be aimed at making the economy more productive, competitive, and resilient. That would help to raise potential growth and reduce price pressure in the medium term. To this end, it is crucial to swiftly follow up with concrete and ambitious structural policies on Mario Draghi's proposals for enhancing European competitiveness and Enrico Letta's proposals for empowering the single market. Implementing the EU's revised economic governance framework fully, transparently, and without delay will help governments bring down budget deficits and debt ratios on a sustained basis. Governments should now make a strong start in this direction in their medium-term plans for fiscal and structural policies. Annual inflation fell further to 1.7% in September, its lowest level since April 2021. Energy prices dropped sharply at an annual rate of minus 6.1%. Food price inflation went up slightly to 2.4%. Goods inflation remained subdued at 0.4%, while services inflation edged down to 3.9%. Most measures of underlying inflation either declined or were unchanged. Domestic inflation is still elevated as wage pressures in the euro area remain strong. Negotiated wage growth will remain high and volatile for the rest of the year, given the significant role of one-off payments and the staggered nature of wage adjustments. Inflation is expected to rise in the coming months, partly because previous sharp falls in energy prices will drop out of the annual rates. Inflation should then decline to target in the course of next year. The disinflation process should be supported by easing labor cost pressures and the past monetary policy tightening gradually feeding through to consumer prices. Most measures of longer-term inflation expectations stand at around 2%. Turning now to our risk assessment. The risks to economic growth remain tilted to the downside. Lower confidence could prevent consumption and investment from recovering as fast as expected. This could be amplified by sources of